Side, upgrading their guidance, both of them. There are still a lot of holds on Next in terms of the city and what it thinks this business can deliver. But how much will this lift the rest of the sector, the likes of Marks and Spencer's? We'll keep an eye on car makers as well, Guy, this morning.
We are, and the car data really weak out of Europe once again this morning. All right, here we go. It is time for the opening trade out of Europe. Futures are pointing us to a positive start to the session here in Europe, despite the fact that we did see that sell-off into the close in the United States yesterday. And let's see what we actually end up with this morning. The FTSE 100 is out of the gate. It is positive, but it's only up by, here we go, we're climbing now more positively, and the stock 600 is up by 0.5%. Do we continue to get more positive over the next few minutes? Do these numbers continue to climb? The indications are from the FTSE 100 that we are moving up towards that expected, let's call it circa 1% move higher this morning. It's fascinating. Are we taking our cues from Asia? Is Asia a better guide to the reaction that we should be taking, that equity markets globally should be taking to the Fed? I think it's absolutely fascinating. The CAC is out of the gate already this morning. It's up by 1.5%. Very strong story coming out of France. Spain's up by 1%. Anna, it is the positive start that we thought we would get, but didn't necessarily think we would get as we were looking at the US close last night.
Yeah, the US close was much more confused. Maybe Asia and Europe coming into this and just not overthinking it quite so much and saying, look, we've got 50 basis points from the Fed. Let's just dwell on that fact for a moment, shall we? And certainly that's what the sector breakdown looks like here in Europe. And I mean that in two ways. One, the fact that no sectors are in negative territory. So that tells you something about risk appetite. And secondly, we've got even basic resources going higher. I mean, that's a sector that often moves around with the China dynamic. But we've seen Asia stocks jumping on the US rate cut story. And that's lifted Asia stocks. And now we've got basic resources here in Europe. That sector higher this morning, up by 2.3%. But a number of sectors up by more than 1% today, including energy, consumer products and services, which did badly yesterday.
Yep.
So the stage was set yesterday here in Europe for something much better today, because there was a lot of negativity in the price action yesterday.
Next is up by 4%. So those that didn't believe maybe believe a little bit more this morning. The upgrade to its numbers certainly being taken positively by the market. So that stock is doing very well. You're also seeing the luxury names doing very nicely as well. This is the stocks 50 that you're looking at there in terms of the performance on the screen. As you can see, the luxury names being driven higher. Is that an Asian trade story? Is that a dollar story? What is that? But certainly you've got Richemont, LVMH, Hermes, all moving up really quite nicely this morning. That is where we're seeing this significant strength. On the wider stock 600, you've got Next doing well. Norsk Hydro is trading strongly as well. Worldline, Delivery Hero, all up quite nicely. Swatch Group in the mix as well. So investors digesting around the world this picture as to what we got from the Fed and what that picture really is. Let's listen to how some of them have been telling us about their thoughts about what happens next and that 50 basis point cut.
Here's the headline. Fed cuts interest rates by 50 basis points and the bond market returns are going to be negative today.
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about.
The market's going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually a steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
We would have liked to have seen the median dot for the end of next year, somewhere around 2.75% to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is, how do you 250 without scaring people that you know something bad about the economy? And I think he did that very well. He basically said, we're doing this because the news is good.
Joining us now to add her voice to this conversation, Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management. How do you see the price action?
I think it makes sense. The Fed gave us, I think Powell put it really well. It's a good, strong start. You know, there isn't sufficient progress in inflation. And then you had a more threatening slowing in demand in the labor market. So given the balance of risks, makes sense to get out of that really restrictive territory just quickly, to give that market comfort that your hand is on the trigger, ready to go, and to support the labor market.
Okay, but how close to the trigger is the hand at the moment? Because certainly the message seems to be, we've done 50, but don't assume that you can extrapolate that forward.
Yeah, I think they wanted to send the message that it is a recalibration cut. Powell told us that there's nothing in the economic projections that suggests that the committee really is in a rush, but that they will speed up if they need. They will slow down if they need, they will pause if they need. So I think the Fed is very sensitive to the labor market. We think they probably are indicating more 25s, and then I think they're going to have to go consecutive from there, but in 25s. But they are very sensitive. If they're going to see further weakness in the labor market, they will speed up to 50 again.
Kim, tell us about bear steepening of the Treasury curve, because we saw a bit of that after this news dropped. Is that something we're going to see into the future, or is that just a part of that knee-jerk response? How would you expect bond markets to position out of this?
Yeah, I think I view that more as a washout of positioning, a bit of profit taking in long duration positions that are further out the curve. I think the curve is going to continue to steepen, but the big move is going to be bull steepening. For that, you're going to need the market to flirt more with that recession narrative, which I think it can do over time as the data continues to weaken. And that's why I think as well, you know, you're pricing 25 for this, you're pricing more than 25 for the rest of this year, even though the Fed has told us 25. You've got to have a bit of that recession risk in the market.
Do you think the market is going to, we were talking to Mark Cudmore about this earlier on then, so do you think the market is going to move the Fed closer to its way of thinking, or the market's not going to get all the cuts that it's pricing in, because it's pricing in 50 basis points more by the end of 2025 than the dot plots?
Yeah, I think the market pricing is fair, and I think the risk is that they might have to deliver more, and the Fed's going to have to deliver more. So I think it's more likely that the Fed moves towards the market, but it's going to be the data that ultimately tells us where we're going. I think, you know, our base case is still a soft landing. I think in a soft landing, you can still see more cuts. And the reason for that soft landing is that the Fed gets the message. I think we have, what gives us some comfort is a slowing, still very low level of layoffs.
Yeah.
I think balance sheets are still very strong. And I think leading indicators are showing cooling and not collapsing. So I think that combination together, I know it's very rare, as history tells us, you know, for the labor market to really just stabilize from here. But those things are things that give us comfort, at least for the next
This is the bit that I don't understand. The market signaling recession, and I hear that kind of that recessionary kind of element in what we're seeing in terms of the way that the curve's developing. Powell sounds really confident that he can stick the soft landing.
Yes, I mean, that just goes to how difficult a message, I suppose, it was to deliver. I mean, we heard Dudley was convinced, wasn't he, that Powell had delivered the message very well. You sound like you understood exactly what was trying to be communicated there, Kim. But at the end of the day, he was delivering a really big cut into an economy that he says is doing okay.
Yeah.
And, I mean, does that explain why we see different asset classes responding differently to the messaging of yesterday?
Yeah, I think, you know, they gave us the 50. They told us it's a recalibration. And I think what the bond market is saying is we're not really worried yet that this is going to really cause a reacceleration or reignite inflation. And that makes sense to me. You know, I think we forget that sometimes 3-month annualized inflation is actually below the Fed's forecast right now. So we've spent a lot of time this year talking about upside risk to inflation. No one started talking about downside risk to inflation yet. And I think also the question of whether this is going to reignite is more relevant if we are closer to neutral. You know, we're currently still in very restrictive territory. The Fed tells us neutral is around 3. We'll put heavy bands of uncertainty around that. But even after yesterday's cut, we're still just below 5%.
I kind of feel like I'm done with the Fed now. We've spent a lot of time over the last few weeks talking about the Fed. I just wonder whether we need to move on to politics now. Because the biggest risk, certainly to the long end of the bond market, has to be now that we see a much more inflationary Trump presidency, a marginally more inflationary Harris presidency coming through in the United States. If Trump comes through, the policies he's talking about at the moment feel inflationary. Is that the bigger risk now to the bond market than whatever the Fed is talking about doing, saying?
Yeah, so I think, we've got some time till the elections. They are a lot closer now, but I think the data is still going to drive us till we get to the elections. And I think that's because we need to see something in the data that's telling us that the economy is not continuing to roll over. That will then shift those election pricings forward, or a big shift in election probabilities. I agree with you that if we get a Republican sweep, that's going to be the biggest risk to bonds. It's going to be higher yields, I think, if we take Trump at his word, tariffs, immigration, tax cuts, deregulation. I do think the impact on growth is arguably more ambiguous, but you're going to see higher yields. And if we don't get that sweep, then I think on net you possibly see lower yields. The impact of tariffs, but not enough on growth to support on the other side.
What do you see in gilts?
Gilts are interesting. I think the Bank of England is just in such a different place from the Fed right now. Not to say that in a few months' time they won't be in a more similar place, but the inflation narrative is just still so different.
Doesn't feel like it's made the journey yet. The Fed's made the journey from worrying about inflation to the labour market. The Bank of England hasn't made that journey at all yet.
Yeah, and I think that's fair. The balance of risk just haven't shifted like the Fed. I like to look at three-month annualized inflation just to get a feel of near-term momentum in inflation. If I'm looking at core UK, we're about 3.8, US were 2, services were at 4.8, the US were more like 2.9, and on wage growth we're at 5.5 in the UK. Yeah. And that's only 3.5 in the US. So the Fed can have a lot more confidence that the battle with inflation is done and shift their focus to the labour market. But the Bank of England just can't do that yet.
Okay, so the Bank of England is behind in terms of its ability to move on to the labour market dynamics. Someone that, a region or a country that is way out in front and very much has its own dynamics, I accept, is Switzerland. We saw them cutting interest rates really early, and inflation has been quite weak because of the strength of their currency. But I just mentioned this morning because we've got a new inflation assessment out from the Swiss government today, and I just wonder if it tells us something about how even risks to the downside on inflation coming through, because the Swiss government saying 2025 inflation in their assessment, they're putting it at 0.7%. The prior forecast was 1.1. There's quite a big downgrade in their assessment of inflation. And is this, okay, Switzerland's its own special case, but do we, at some point, do we need to start worrying about risks to the other side of inflation? We've been so obsessed with high inflation in the last year or so.
Yeah, so I think this is where it's going to get interesting for the Bank of England and the ECB next year. I think there's a big indexation issue in the UK and Europe. And a lot of that number is going to come up quite swiftly from base effects next year. And I think in Europe especially, we've got much bigger downside risks to growth that are showing through in the data. The ECB can't move yet because it's got an inflation mandate. Inflation is still sticky. We've got delays in wage negotiations, labour hoarding, still keeping the labour market pretty okay, and prices still pretty high. But I think they're going to have to speed up next year faster than what the market's expecting, precisely because you're going to get suddenly those downside misses to inflation versus forecast and weaker growth as well.
Yeah, it's not a great combination. But they don't have as much room to manoeuvre, maybe, as the Fed does in terms of the way they can cut. Kim, nice to see you. Thank you very much indeed for stopping by to see us. Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management. Thank you very much indeed. This is what the Call 6 looks like this morning. Luxury stocks definitely on the front foot. We're seeing that strength coming across Europe. As you can see, LVMH up very nicely, up by 2.77%. Elsewhere, we are broadly higher. There's very little in negative territory this morning. We are seeing some of the retailers in the UK having a very strong morning. Joe Easton, what are we watching?
So it is a big day for retail, as you say, though. We're actually seeing the stocks retail index hitting a record high now. Data going back more than 30 years. That index is trading at a record. Part of that move is due to Next in the UK. That jump in sales guidance, once again upgrading their view on the year ahead. And we're also seeing a big move higher in Ocado. The stock is up around the most in a year for Ocado. Now, bear in mind, down heavily on concerns around the automated warehouse business, but the retail sales out of the company, the partnership with Marks and Spencer's, looking really strong. We're up 14% on Ocado. Next, up around 4% at the moment. One stock going the other way is Allegro over in Poland. This is a retailer as well. Really weak guidance out of them this morning. That one absolutely slammed, but we're going to take a look at shiny, posh watches, because Guy mentioned luxury doing well today, but watches doing particularly well. Data out of Switzerland showing a big jump in Swiss watch exports, really a defensive part of the market. Rolex, Swatch, those kind of products tend to be pretty steady no matter what the economy does, doesn't it? But that area of the market looking pretty strong today. Then in terms of M&A, there's a little one in the UK. Not sure if we've got a price yet. We've got a massive unch on the screen once again, which means we haven't got a price. But take my word for it, this stock is going to rise because Capital & Regional, it's a real estate company in the UK, takeover bid from New River, another real estate property takeover in the UK. Really an interesting sector. And then Close Brothers, earnings out of them, but they're also offloading their asset management business. This is the company that owns the Winterflood stockbrokers in the UK as well. And our daily check-in on Commerzbank, there's a report saying they're looking to push on with a change in CEO. So we're keeping an eye on that one amid the UniCredit interest. A bit of rare red on the screens there. Commerzbank coming down today. Then in terms of some of the mining stocks, there's Anto. Now, even with that Morgan Stanley underweight, it's still gaining, given the positivity around the Fed, around interest rates. So we're seeing green across the screen now. Guy did mention Norsk Hydro earlier. That one is actually an overweight over at Morgan Stanley. They like that one. They like the two down the bottom, Norsk and Rio. They dislike Anto and Boliden. But look, green across the screens, everything rising, giving the focus on the Fed. One stock going down, though, Deutsche Telekom. Now, remember, this company owns T-Mobile in the US. T-Mobile numbers weak last night. Cash flow looking really poor on T-Mobile. So that is hitting Deutsche Telekom. So we can find some red on the screens if we look close enough. So that one coming down. And then another one, another Deutsche, this time Deutsche Post. This one is downgraded today to underperform over at Exane. Now, Exane predicting that Deutsche Post will do a profit warning in the next couple of months because of weakness in some of the freight markets. So that one coming down. Most of the screens are green, but a couple of stocks declining today on the early trading.
Thank you very much, Joe. Yeah, I was just looking at that Deutsche Telekom share price and wondering why it was bringing the whole telecom sector down. And here's Joe to explain it to me. So thank you very much. Joe Easton with the latest on those individual stock moves. Coming up, we'll talk more about the car sector. Germany EV sales slumping in the latest piece of bad news for the region's biggest car market. Some really tough comparisons with last year. We'll talk about what's happened since. More on the embattled auto sector next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
80 minutes into the equity market session, let's call it 19 minutes. This is what the picture looks like. A little bit of a fade, maybe from the early indications that we're going to see kind of 1%, more than 1% across the board. France is doing well. The reason for that, we are seeing luxury stocks having a very strong start to this morning. As Joe was pointing out just a moment ago, watch stocks in particular are having a good day, both in France and in Switzerland. But luxury stocks more broadly, the heavyweight names like LVMH, Hermes doing very well right now. Let's talk about what is happening with the macro picture. We move our attention from the Federal Reserve yesterday to the Bank of England today. The BOE likely to decide, we understand, against cutting UK interest rates. That will be the second straight meeting that we have seen it. The last meeting was obviously interesting in terms of the vote split. What are we going to see today? Joining us with a preview is our UK correspondent Lizzie Burden. She's outside the bank. So 50 basis points from the Fed. Can I extrapolate into the room at the Bank of England where the meeting is taking place? Will they pay any attention to that? Or is this a domestically focused Bank of England right now?
I'm sure that they'll be paying attention, Guy, via the exchange rate. But look, the movement was already priced. The expectation of that half-point cut from the Fed meant that traders did already ramp up their bets for a cut from the Bank of England today. But look at the flip side of the argument. In a way, Jay Powell's already done the work for Andrew Bailey yesterday, and he managed to pull off the messaging about a soft landing, perhaps. So there's no need to fret on Threadneedle Street. On top of that, you had the services inflation reading yesterday spiking, which is a cause of concern for the Bank of England. And you had Andrew Bailey at Jackson Hole sounding cautious. So that's why economists still expect a hold from the BOE today with a less finely balanced split than last time. 7.2 is what we're looking for. And actually, most economists reckon that the pace of asset sales is going to stay the same at £100 billion a year. But that part in particular will be watched closely by the new Chancellor Rachel Reeves as we head towards her October the 30th budget.
Yeah, we were talking about that unfortunate linkage between monetary policy decisions on the balance sheet and fiscal headroom. We were talking about that with Jens Larsen earlier in the programme, Lizzie. But in terms of the basics of monetary policy and the path ahead for rates, is November in play then now? Are we expecting any clues from the bank around November? I'm not sure we hear all that much from them today.
No, we don't. We don't have a press conference. We don't get updated forecasts, but they might nod in the guidance to lower inflation and lower growth given the recent data. The reason that November will be more interesting, and indeed traders are pricing in cuts for November, December and 5 in 2025, is because we'll have more data and a budget on October the 30th. And at the moment, it looks like Rachel Reeves is going to try to plug that £22 billion hole in the public finances. And there's speculation that to do that, she will raise taxes. So if there is a fiscal tightening, many are wondering whether markets have yet fully priced in the slowdown effect of that budget on the UK economy.
OK, Lizzie, thanks very much. Thanks for the briefing. Bloomberg's UK correspondent Lizzie Burden outside the Bank of England, of course, for us. Let's pivot to the German economy right now. And one dynamic there we need to keep across is what's going on with the car sector. Germany has led a drop in European car sales. Deliveries were dragged lower by EVs, which plunged 69% in the year to August in the region's biggest car market. Let's get more then with Bloomberg's Oliver Crook, who's been, of course, following the auto sector, following the German economy, and can bring those two together for us. Ollie, good morning. So more bad news then from the auto sector.
Yeah, I'm sad to report today that the month of August was a very bad month in terms of deliveries across Europe. If you look at just sort of the headline numbers, the sales of cars generally in Europe fell by 16.5%. When you drill down into the countries that were most sort of influential in that, you go to the biggest economies in Europe. You go to Germany, you go to France, you go to Italy. Germany sales were down about 30%, France about 25%, and Italy down 13%. When you look at what that means for the year-to-date figures for both Germany and France, this August figure basically wipes out all of the gains this year so far. So their car sales year-to-date have grown 0%. When you look at the different brands and how badly everybody else was affected, you go to Volkswagen, their sales were down 13%. Which is actually relatively good compared to Stellantis, which saw sales diminish by 30%. BMW 15% down, Mercedes 10% down, and of course Tesla down 36%. And so you're seeing a moment here in the economy within Germany, but of course the broader economy within Europe, where you're really seeing these car makers struggle severely, whether it's BMW on that recall, but of course Volkswagen talking about closing factories in Europe for the very first time. They're also closing factories in China in some of their joint ventures with SAIC. That's news that we've got out fairly recently. So again, fairly grim picture in terms of demand.
Ollie, we're meant to get rid of ICE engines by 2035. Looking at today's data on EVs, is that going to be possible? Does Europe have a problem with its targets?
I think they may very well, and you're going to hear a rising chorus around that. If you just look at what we saw in terms of the EV market, if sales were bad across the board, they were really bad for EVs. You look at the EV sales across Europe, they were down 36% in the month of August. That means that for the year to date, they've been down 6%. And again, drill down into these markets. EV sales in Germany down 70%, down 69%. In France, down 33%. This is all in part to do because they got rid of a lot of incentives that were there for EVs last year, so the year-on-year comps are not great. There is one bright spot, Guy, and that is the United Kingdom, where EV sales rose by 11%. The year-to-date figure there also up 11%, so the EV story still intact, at least in the United Kingdom. But when you look at this sort of across the board, gas versus EVs, there is one clear winner, and that is hybrids. It was a poor month for gas cars. It was poor for battery electric. When you look at hybrids, August sales for hybrids up 8%. Year-to-date, they're up 20%, guys.
Yeah, I wonder if people still just look around and don't see the infrastructure that they want to see to make that full leap. We just briefly, Ollie, we might see some action by policymakers on various fronts. I know there's been a lot of conversations about the tariff level on Chinese cars. Those conversations continue this week. We get a decision next week.
Yeah, absolutely. So the member states and the EU still need to sort of vote on this with grand finality. Of course, it was sort of consensus buildup, though there were some people that were kind of resistant to it from the beginning. We know the Germans, for example, were kind of resistant to it. They had a lot of objections even at the Schultz level. They kind of backtracked a little bit, but then you had Sanchez coming and saying, we actually don't know if this is such a great idea from Spain. So sort of interesting, that debate going there within the EU presently.
Ollie, great stuff. Thank you very much indeed for updating us from Berlin. Ollie Crook on the auto sector. The tennis season's Grand Slams are behind us, but the sports superstars are now descending on Berlin, where Ollie Crook is for the Labour Cup. Our own Mr. Crook caught up with the former number one, John McEnroe, who's criticising the distribution of money within the sport of tennis.
After, the amount of money that's paid at the U.S. Open, which is record money compared to what we were getting, 14% of, and that's including the women, out of the revenue. I mean, that doesn't seem to be totally fair, and that happens at all the big events. And I don't want to, I don't think you have enough time to get into sort of the machinations of what goes on, but let's just, needless to say that we're just like hired guns.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back, everybody. This is the opening trade, 30 minutes into Thursday's session here in Europe. And post the Fed, post the 50 basis point cut from the Fed, it seems that risk assets are to the fore. Stocks are higher this morning. We're up by 1.2% on the French market. Luxury stocks, consumer products not doing too badly. Basic resources lifting. London, that sector doing okay. Retail also getting some good numbers out of the London suite of corporates. And so that sector doing okay this morning. In fact, only two in negative territory, utilities and telecoms. US futures also looking higher. E-minis now up by 1% this morning. Let's talk about what the Fed cut means and look beyond to market positioning. We'll talk to John Bell, portfolio manager on the equity income team at Newton Investment Management. And a real pleasure to have you with us, John. Thank you so much for coming to talk to us on set here. So let's talk about the here and now and post the Fed. You know, what is a 50 basis point Fed rate cut? What is it good for? Seems to be good for stocks here in Europe at this point.
Well, first of all, thank you very much for having me. I think that the market got what it was looking for, didn't it? The expectation was that we were going to get a 50 basis point cut. I think the initial reaction was positive, and then we sold off a little bit, perhaps, as we listened to Mr. Powell saying this isn't necessarily the path towards some significant rate cuts, and now things are rallying. And I think what we're seeing is a belief that the Fed has got everything under control, that they're going to engineer a soft landing, and therefore risk assets are moving ahead quite strongly.
Yeah, I mean, if this is good for stock prices, is there less need to go looking for yield? I know that, you know, that's where your portfolio focuses, but thinking about it in relation to other things, is there sort of less need for it if we're going to see stock prices go higher?
I think the macro and the Fed is one thing. That's clearly very important to the backdrop. But I think there are other factors that we need to look at, positioning and valuation. And certainly positioning had got very, very extreme. We saw midpoint in the year. It didn't take much in terms of the BOJ raising rates to unwind a carry trade, create some panic in markets. And I think really the key to that is that people are very positioned strongly towards growth, and people are very much positioned towards technology and other areas of the market where valuations are high. So we would argue actually that there is a need for income, but income as a diversifier against growth portfolios, given the valuation of growth, given what happens when there's a little bit of uncertainty, the sell-off that we saw was very rapid, that there is a clear role for an income-related portfolio as a diversifier of equity risk.
Defensive stocks have done really well recently.
Yes.
You're long defensive stocks.
Yes.
Are you lightening up on defensive stocks?
Yes, absolutely. I mean, if you look back again to that midpoint in the year, we had perhaps our most extreme positioning ever. We were the most overweight utilities we've ever been. We were the most overweight financials, the biggest underweight we've ever seen in technology. And as you say, positioning has moved very much in that direction subsequently, and as a result, we've tempered that position. So we are still overweight those sectors, but by less than we were at that point.
Just thinking about the Bank of England today,
yes.
Is cash still a headwind? Is cash still an opportunity if I'm an income-seeking investor right now, and how much of a headwind, therefore, is it to you? You're still getting kind of 5% circa out of a money market fund here in the UK.
Yes, and I wouldn't necessarily expect, more broadly, a very dramatic rate-cutting cycle. I think the flexibility of central bankers is reduced somewhat by higher and likely more persistent inflation. So it is an asset that has some attractions. I think the big difference between equity income relative to cash and fixed income is that we have the ability to see dividends raise the income to go up and therefore help to generate an increasing income stream that you wouldn't necessarily see.
So what are you getting just in terms of income? What am I getting relative to cash at the moment? What's the kind of...
About 3.75% is the yield on the portfolio at the moment, so relative to an equity overall yield of 1.9, so significantly higher, and then a growing income stream on top of that.
And thinking about the sector positioning within that, and you talked about how, yes, in the middle of the year, when everyone was so, peak excitement around AI and the Magnificent Seven had done so well, and then since then things have come off a bit, and we know that. How do you position around technology now then, given the sell-off we've seen? And actually, just looking at your top 10 holdings in your global income fund, there are tech names in there. They're not necessarily the ones who make the chips, but they are technology related.
Yes, well, we're still significantly underweight, and part of that is because we have a very strict yield discipline, which means effectively we can only own companies that have a higher yield than the market, and that makes our tech universe somewhat restricted, and in many ways that explains why we're so underweight. But we can still get exposure either directly through companies like Cisco Systems, Samsung Electronics as well, which is semiconductor related, memory, of course. But we can also get exposure to the pace of technological change through other businesses. The advertising holding companies, for instance, which in many ways are technology businesses, using artificial intelligence, using big data to produce content more cheaply, to produce more targeted marketing campaigns, but they are being valued as if they're no longer relevant, whereas many of the technology companies are being valued much, much more aggressively.
How do you see technology companies and their attitude to dividends? How is that evolving? Is it evolving, or are companies just getting older and maturing and therefore deciding to pay dividends in the way that companies in any other sector would?
There is less yield, clearly, coming from technology companies. I think the yield on NVIDIA is 0.03%. I've never had to look to the second decimal place to find a yield before. But so there is some culture of dividends. I think there's probably more of a culture of buying back shares, in keeping with much of the US market as well, as a means of returning cash to shareholders. With maturity, we may well see more dividend payments, but I think these companies still are very much set on reinvesting and growing the business as fast as they can.
So somebody like Microsoft, I think there is return of cash to shareholders there, but that's because of its maturity.
Yes, and we historically have owned Microsoft. I mean, there was a period when Microsoft had a yield significantly higher than the market, and people viewed it as an obsolete company, that it was going to be replaced by other operating systems. It was clear to us that was never going to happen, and we were comfortable owning the shares. Subsequently, they performed very strongly and much more highly rated.
Are banks going to continue to be income generators? What happens on the tax front? Is there going to be a threat?
Yes, I mean, if you look at our financials weighting, it's dominated by non-bank financials, insurance companies, exchange-related, so volatility-type plays. We do have some banking exposure, none in the UK, topical as to whether there may or may not be a windfall tax on banks. They are and have always been relatively high-yielding companies. We have more exposure now than we would have done historically because the regulation, I think, is a bit more favourable. The bond market environment is also, the yield environment is more favourable. But we would caution that banks always remain a politically difficult
So do oil stocks. What do you think of them?
Yes, we're limited exposure. We are marginally overweight to energy. Very good income-generating sector. Yeah. Somewhat uncertain future, perhaps, given the energy transition. I think it's interesting that the big integrated companies in Europe are perhaps pulling back from that energy transition to focus more on their core business. That's a very logical thing to do, I think, in terms of return profiles.
Precisely, yep.
But what does it mean for the long-term dividend streams from these companies?
What's at stake, John, when we look ahead to the budget, end of October? What's at stake for either the companies that you invest in or the companies you've got on your radar to invest in? Do you see it having an impact on UK corporates that are on your radar?
We're not really investing on the basis of what might happen in the budget, what might happen in the US election as well. There's obviously a lot of political events coming up towards the end of the year. I think really all they do is serve to reinforce the broader thematic macro backdrop, which is one of geopolitical uncertainty that we would sort of capture under the title Great Power Competition, the battle between liberal democracies and autocracies, the growing size of the state, the intervention in markets. We're likely to see more of that, and broadly we would argue that is an inflationary trend, which brings us back to interest rates and the flexibility of central bankers to react to slower growth, react to markets with aggressive rate cuts, which we don't see happening.
Okay, John, thank you so much for joining us. John Bell, Portfolio Manager on the Equity Income team at Newton Investment Management. Coming up on the programme, a new wave of exploding telecoms devices in Lebanon ramps up tensions between Israel and Hezbollah. We have the latest from the region. That conversation next. This is Bloomberg.
Suppose I want to buy a computer, but I want to have AI in my computer. I want to be really up to date. Do you have AI in your computers yet?
No, not yet, but it's coming soon. And we think this is going to be one of the largest transformations in the PC industry in decades. What will be possible starting this summer is to run large language models in AI PCs, which means that what today all of us are doing in the cloud, where you use any of the applications that you can, you will be able to do it locally. And what this means, which is why we think this is important, is it will be much better from a cost perspective, because running models in the cloud is expensive. It will be better from a security perspective, because you will be able to use the model with your own data locally without having to upload your data to the cloud, and you will be able to do it anywhere in the world. And also for applications where speed is important, where latency is important, you will be able to do it locally much faster. For example, in gaming, where the game needs any resource the computer have, it will be a much better model. So it's going to be a big change starting this summer.
At the same price, too?
Slightly higher price, but if we look at the increase of price versus the increase of value, not comparable.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome back. You're watching the opening trade. 43 minutes into the equity market session. We fade a little bit more, as you can see. We're definitely off our early indications of kind of 1.5%. We're kind of now up by 0.75%, as you can see more broadly across the picture. And we walk our way slowly, I think, towards the US Open, which I think is going to be really interesting in terms of where we're priced currently in the United States. The fair value on the S&P is kind of pointing us towards a rise of around 1.3%, which is much more positive than the negative close we saw yesterday as we came through to the end of the US session. Let's talk about the geopolitics and what is shaping up to be a difficult story in the Middle East once again. More telecoms devices, including walkie-talkies this time, have exploded in Beirut and in other areas across Lebanon. The country's health ministry puts the total death toll now at least 26 people. Israel's military has declared a new phase in the war and says troops are now to be diverted towards its northern border. Can we connect these two stories? Jumana Basetchi, our Horizons Middle East and Africa anchor, joining us now. That's the question that everybody's trying to figure out right now. Are these two stories interrelated? How should we think about one relating to the other? Talk us through what happened yesterday and how we should think about it.
Yeah, the perception is the two are very much related from the region, even though Israel hasn't directly acknowledged the series of operations that have taken place in Lebanon. But we did hear from the Israeli Defense Minister, Yoav Gallant, yesterday saying that the center of gravity is moving north. They are allocating forces, resources, and energy to the northern area, that they are start of a new phase of the war, and we must adapt. The background of this, of course, is that Lebanon has been rocked by 2 days of telecommunications infiltrations with communications devices exploding. What we saw yesterday was the catalyst for the explosion were actually walkie-talkies used by group members of Hezbollah that detonated, setting off fires in cars, shops, people's homes. The health ministry, as you said, has put the number of casualties from yesterday's attack at 450. The number of deaths have climbed to 20. And this, of course, comes after those wave of pager explosions that happened the day before, injuring up to 2,800 people and killing 12, including medical workers and 3 children. But of course, lots of speculation as to how this could have happened in the first place. But experts do say that at some point in the manufacturing process, explosive material would have been put into these devices that were then shipped onto these Hezbollah group members. And what it means now is Hezbollah are on the defensive, and so are other countries in the region. Iran, Syria, also on high alert vis-a-vis their own wireless networks as well. One thing to watch out for, the Hezbollah Secretary General Hassan Nasrallah is giving a speech at 5 p.m. local time today. So we'll be watching closely to hear what he has to say.
Yeah, we'll certainly see what he has to say then, Jumana. Now, Anthony Blinken, we know he's been in the region. I think he's meeting with foreign ministers from across Europe today. The United States and many other Western partners not wanting to see this turn into any more of a regional conflict than it already is. What sense of escalation do we see, Jumana?
I think it was pretty interesting that the U.S. Secretary of State Anthony Blinken, who had been in Cairo to push forward the negotiations on the ceasefire, was asked about the operations and the explosions that happened in Lebanon over the last couple of days. And he said that the U.S. had no knowledge. This is a direct quote. The United States did not know about it, nor was it involved in these incidents. We're still gathering the information and gathering the facts. Therefore, that sort of illustrates that the U.S. were not aware that this operation was going to take place. He also then added that the U.S. would like to see a de-escalation on all fronts, that their goal at this point is to get that Gaza ceasefire across the line, because that is going to be the catalyst for the de-escalation of tensions in the region. Yeah. But of course, we also heard from the Israeli Prime Minister Benjamin Netanyahu 2 days ago saying that they have expanded a new war objective, and that is to bring back security in the north. So big question marks about what they're thinking and how they're planning on making that happen.
Okay. Let's Let's just talk about that objective. Security in the north. The objective in Gaza was the elimination of Hamas. What is the objective in the north? What does that security look like? How far can they push back Hezbollah? What does this conflict look like? We remember what happened in the 1980s. How far is Israel prepared to go?
And that is the big question, because what is happening right now is there is pressure on the Israeli prime minister from his citizens, from the public. The thousands of citizens who've had to move away from their homes in the northern part of the country because of the daily exchange of crossfire that's taking place on the northern border with Hezbollah. Similar situation in Lebanon, by the way. Many families, thousands of families have been forced to flee and be evacuated as well. This has been going on for almost a year now. There is fatigue setting in. And what Netanyahu is saying to his public is they want to do something about the security. How far they're willing to go. They say that they're deploying troops at the northern part of the country, but of course they will then have two fronts waging on with the ongoing war in Gaza. Is there going to be appetite to put troops on the ground in Lebanon is the big question. But ultimately what they're trying to do here, Guy, is to push Hezbollah back away from the border. There was a resolution called UN Resolution 1701 introduced after the 2006 Lebanon-Israel war that stipulated Hezbollah have to put down their arms and move up north of the border. They haven't abided by that security resolution, but I think there's going to be a lot of pressure now from the international community to do something about that arrangement.
Jumana, thank you very much for the update. Bloomberg's Jumana Besetcha in Dubai. So oil prices pushing higher today on Middle East tensions, also some of the risk-on sentiment we're seeing post the Fed. That takes us on to the monetary policy conversation here in the UK as well. Let's think about where the UK goes next. Interest rates are expected to be held at 5% by the Bank of England when it makes its decision later today. For more, let's bring in Dan Hansen, Chief UK Economist at Bloomberg Economics. Dan, good morning to you. So, I mean, the decision is not necessarily the interesting part here. Do you think we get any guidance around November, explicit or in passing? Where will you be looking for clues?
Yeah, I think one way to gauge whether November, I think November is really live, given what we saw, well, given what we've heard from the bank and also given what we saw yesterday from the Fed. If you want to look for something that, from the bank that sort of confirms that, in the minutes, if they point to the November forecast round, the fact that they'll take everything into consideration then. They did something similar in June, pointing to August, and we got the cut in August. So if you're really looking for something to confirm your prior, that they'll cut in November, I would obviously in the minutes, in the guidance. To be honest, I don't think the bank are going to really change the message today. There's going to be an ongoing point about caution around services inflation, around inflation persistence. Perhaps the bigger question will be around what they do with QT. You know, what envelope do they go with? But I think, to answer your question directly, if you're looking for a sign November's coming, they'll point to the November meeting and the forecast round and potentially taking a new view around inflation persistence.
Let's talk about that inflation persistence. The Fed, I think, can reasonably say we can put that one to bed. Yeah. The Bank of England really can't. It feels very sticky in the UK right now, and looks like that process is going to continue to be with us for quite some time, sticky inflation. How far can the bank go in cutting rates as long as this dark cloud of inflation is hanging over it? How should we think about the cadence, the kind of the cycle that the bank can deliver with this story still overhanging it?
Yeah, it's really difficult because I think you're always worried as a central banker about fighting the last war. And I think the way the Fed has shifted now, they've been able to do that because I think a lot of it is to do with their mandate. It's very different to the banks. It's a dual mandate. So they can put a lot of weight on that labour market side of the argument. The bank is 2% inflation, and it's as simple as that. There's a secondary element to it where they have to support the economy, but it's 2% inflation. So for us at the moment, it's about a quarterly pace of cuts. It's not about a meeting-by-meeting pace. We saw the inflation data yesterday. It's moving in the right direction, but it is moving extremely slowly. 5% services inflation is not going to get you 2% inflation in the medium term. That's what they're worried about. I think what will be interesting is the latter half of this year into the early part of 2025. What you'll get is headline and core inflation converging. And at the moment, it looks like it's going to converge in and around 2.5–3%. So then you've got the question then. Are you willing to sort of look past that and be like, oh, we're just going to carry on, or are you going to say, look, this is the final part. This is the hard yards, and at that point, there is a very different conversation. As you say, it's sort of, you can probably put it to bed in the US.
here. We're just not there yet. So it feels to me like a quarterly pace at the moment.
So quarterly pace. Would the cuts come more quickly, or maybe bigger, but just maybe more quickly than quarterly, if we saw sizable tax increases in the budget? Link the two for us.
Yeah, I mean, well, okay. So, I mean, the first thing with the budget, I think the thing to remember is that all of these tax rises appear to me to be, they're coming to pay for higher spending. So it's not about austerity, it's about a balanced budget. So if you're the Bank of England, am I thinking, is that going to impact demand? Not hugely. If Rachel Reeves decides to tighten fiscal policy significantly, not increase spending, then yes. The question then goes to what taxes she increases. And if it is focused around wealth taxes, actually the demand impact is relatively small, because in economist jargon, the marginal propensity to consume of those individuals is relatively low, so the hit to the economy, they can absorb the hit of higher taxes. So I think it's an interesting one, and actually it's another argument for waiting to see the budget, to see exactly what the fiscal strategy is, and then moving potentially in November.
The housing market feels like it's getting a new lease of life at the moment.
Yeah.
Is that sustainable? Like if we're seeing a quarterly cut in interest rates, is that enough to keep the kind of the acceleration that we're seeing at the moment on track? Because that has a meaningful impact on people's perception of their wealth and their ability to go out and spend.
And it is about, you're right, it's about perception. I think it is just about enough, the way we're going at the moment, to keep it on a relatively modest upward trajectory. I don't think we're going back down. I mean, one thing that's happened recently, given what's happened with the Fed, is that swap rates have fallen quite significantly in the UK. And obviously, that's what matters for the mortgage market. It isn't what the bank does meeting to meeting, because almost everyone's on a fixed rate, not a variable rate. So actually, there's been a bit more impetus put into the housing market again by what's happened globally. So I think over the sort of 6 to 12 months, there's no real reason to think house prices are going to go anywhere but upwards, even if it's just sort of 2 to 4% growth rate, nominal growth rate over that period.
I got an unsolicited phone call from an estate agent for the first time in a number of years the other day, asking if I just want to sell my house. You know, if that's the sign of anything. So, Bank of England in focus today. Dan, thank you very much. Thanks for joining us. Dan Hansen, Chief UK Economist for Bloomberg Economics. Thinking about what is ahead then, Guy, yes, we have the Bank of England rate decision. We always also have a Norwegian rate decision, no expectation of change just yet there. And also from Turkey and South Africa, of course. Then we get some US data and some ECB speakers and FedEx earnings.
You're quite excited about FedEx earnings, aren't you?
I always get excited about FedEx earnings. You know, sometimes they just throw you something interesting on the US consumer.
But that's where it's about. That's the story. That is where we need to focus our attention. What is happening with the consumer? I think the UK story, I think, is really interesting as well. I think what's Next just told us this morning is really worth paying attention to. The consumer feels like it's holding up. That's why I asked the question to Dan about what is happening with the housing market. How is the consumer feeling in the UK right now? Housing market's recovering. Next is telling us positive things. That is a huge support for the UK economy right now, but it also maybe marginally just keeps that service side inflation quite strong. Are people going, if they're spending in Next, does that mean they're going out and eating out more? Are they going to the pub more often? Does that support that side of the market where the labour market is very tight, where it's difficult to get staff, where wages are still rising relatively aggressively?
Another couple of themes to keep an eye on today then. The auto sector, we talked about that. There's a lot of toing and froing of different voices between China and Europe right now to try and settle this question of how high those tariffs are going to be. We've seen the strains on the domestic European automakers overnight, haven't we, with that really dreadful sales report and the drop back in EV sales. So we'll keep an eye on that. And from a geopolitics perspective, Anthony Blinken in the region, talking to a lot of foreign ministers.
The big question I have today is US equities sold off into the close yesterday. We've then got this pop this morning in futures, which has come out of Asia. Europe has responded to it. I'm looking at the numbers now. They're beginning to fade a little bit right now, but we're still elevated. We're still up by, let's call it 0.75%. Does that momentum continue into the US Open, or is the Asia story a head fake? And actually, the US close is actually where the heads of US traders are really right now.
Yeah, because the US picture was a lot more muddled. Asia and Europe maybe not overthinking it and just saying, you know, we've got 50 basis points, let's buy this. And to your point, Asia pushed the US futures picture higher. In Europe, yes, it faded a bit, but doesn't seem to be questioning that too much. So we'll see how that develops through the day. We will know by tomorrow. That is it for the opening trade today. European stocks then on the rise this morning, up by 0.8% post that big rake up from the Fed. The Pulse is next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
The Fed goes big while stocks rally after an outsized cut in the U.S. interest rates. Chair Jay Powell cautions on the speed of further easing. The BOE is next. Economists expect UK rates to stay on hold, but will Governor Andrew Bailey actually hint at a reduction in November? And Israel actually declares a new phase in the war with regional Islamist groups as Lebanon is hit with a second wave of exploding electronic devices. So let's take a look at the European markets map. Now, overall, of course, it's all about this jumbo cut and what exactly it means for the Fed's thoughts about the labor market, but also inflation going forward. So we're getting a nice little lift. A lot of it was priced in, but again, it's always nice to start with a 50 basis point cut for the first cut in 5 years from the Fed. You can see the FTSE gaining 7.9%. The CAC 40 actually gaining by similar amounts. Cross asset, look, there's going to be quite a lot of things going on. We have a lot of Fed speakers over the next couple of days as well. Dollar actually weakened, and an index of Asian currencies rising to the strongest level in more than a year, and then treasuries pretty much steady. Bitcoin, look at that. We love looking at Bitcoin, 62,081. We'll also look at some of the other things, including Norges Bank leaving its benchmark interest rate at 4.5% as expected, and it sees the rate likely and at that level until the end of the year. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So the Fed has opted for an outsized interest rate cut designed to preserve the strength of the U.S. economy as risks mount to the labor market. Speaking after the meeting, the chair, Jay Powell, said the half-point cut actually reflects the central bank's risk management approach as they aim for a soft landing.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. A broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
Well, joining us now for more on the markets, Tim Graff, head of EMEA macro strategy at State Street Global Markets, and our very own Mark Cudmore, our Markets Live executive editor. Mark, this is an exciting day. The Fed cutting by 50 basis points. Markets went down because Jay Powell seems to have made clear that actually he won't keep cutting this fast. I mean, what was it, like a dovish cut?
No, this was not an overly dovish cut, given the expectation that, there might be even more priced into the curve in the dot plot. In a way, it was a slightly hawkish cut, but with a slight twist. The fact that they even went 50 basis points, the fact that we got to the situation, they had to yesterday once 40 basis points is priced, but the fact they guided to 40 basis points pricing just shows the extremely dovish reaction function of this Federal Reserve. It shows they don't really have a dual mandate. They absolutely prioritize the labor part of their mandate, and that they are willing to ease as soon as there's signs of cracks there. And it's that broader dovish message, that's the kind of the idea of the very dovish reaction function, even if in the short term they didn't deliver as much in the dot plots as the rates priced.
Yeah, and the dot plot, actually, Tim, is extremely key to try and understand what comes next. And it's very clear that there was a big shift in the predictions for where the rate will be at the end of the year.
Yeah, and I think really what the Fed did, kind of to Mark's point, is that they really just sort of justified market pricing. Market pricing really has rates only getting to neutral out to 2 or 3 years. There's a little bit of a deviation, but it's a couple of years out. It's so small, it doesn't really matter. So I think that's why you have maybe some hawkish interpretation. Even though it was a dovish move, it was a bigger cut than was priced and was expected last week. But as Powell said in the press conference, I think if they had the July employment data, they would have probably gone in July. And so this is a little bit of a catch-up, but the pace is 25. And I think maybe the market had hoped the pace might be a little bit faster, but it's a little bit more of a gradualist approach is the message.
But, Mark, and I know the market is almost never wrong, but given what Jay Powell was explaining and given where the markets actually ended up, they decided to retreat as this mega cut they saw as a disappointment. Are they right?
I don't think this is a disappointment. I mean, overall, while cash equity markets closed down, stock markets are clearly higher. Futures are way higher since the decision. All across the world. I mean, this is a very clear bull market. It's a bullish signal. We've seen equity markets everywhere rally. We've seen crypto markets rally. And I said, including in U.S. markets, just cash markets closed a little bit weaker. But overall, futures markets are up significantly since the decision. So this is an extremely bullish decision. And I use the word bull market. What I mean by there is in the classic old term that in a bull market, you don't worry about the kind of twists and turns, the short term. Who cares if the markets are going to be up in 24 hours from now? The point is the underlying trend is very strong. You've got good global growth. You've got good U.S. growth. Sure, it's not booming, but global growth is set to be better than last year. U.S. growth is probably set to be similar than last year. This quarter's growth in the U.S. is set to be better than last quarter. So growth is doing absolutely fine. Meanwhile, you've got central banks easing policy. Earnings are still good. Energy prices are low. Disinflationary trends are still in place. This is an incredibly bullish market and bullish environment. At some point, those factors will change, but they'll need more than one to change. So the market at the moment is taking this very, very enthusiastically, and rightly so. They will not continue gaining at this pace, though.
Tim, I mean, some could argue that actually, such a big cut was just not necessarily, because big cuts generally happen in great times of stress, the pandemic, the global financial crisis. Is there a worry that actually they underestimate the impact of inflation longer term?
I don't think so, because income growth is starting to slow. You have for whatever it's worth, productivity growth in the U.S. is relatively strong. And so the wage growth you're currently seeing, which really future inflation almost has to come from wage growth. The pandemic-era stimulus has been spent. You are going to get easier conditions now with rates easier, I suppose, and that may create some upward pressure on inflation expectations. But those expectations are really well contained. The Fed could feel very confident that that part of their dual mandate, which I disagree with Mark, I think they are paying attention to the dual mandate insofar as inflation has normalized enough, but more importantly, expectations are very contained. They can go ahead with that, and it really is labor market or labor income growth that will create future inflation. But the growth we're seeing, given productivity growth, is not inflationary at the moment. And I think that's why they felt so much more comfortable acting forcefully to start.
Mark, what's your take on what happens next? And again, I know there always needs to be some observation on politics. I feel like it's unavoidable so close to the election, where also one of the candidates politicized the Fed.
Yeah, I mean, look, I think that politics is the next big risk out there. I think in many ways, the Fed as the big risk for the market has taken a back seat for the moment. The Fed's always one of the most important drivers in the market, but it's not going to derail things at the moment. I think, in going to Tim's point about inflation under control, he's right that the disinflationary trend is very strong, and I think he makes a valid point on the lack of inflationary impulse from the productivity side. But my worry is that we give too much credence to inflation expectations when really these are things that we've relied on in the past 40 years when we didn't have an inflation problem. When we suddenly had an inflation problem, they proved just wildly useless. They did not move or give us any indication of the scale of the inflation shock we'd then get. Now, many would say, well, that's why we managed to eventually control the inflation problem, because inflation expectations didn't get unanchored. But I'm worried that we've got too much complacency in the system around inflation expectations. So short term, yeah, disinflationary trend is still there. I am worried that with this triggering of animal spirits, with the impulse going back into the economy, that there is a risk that inflation does rear its head again in 2025 unless we get a sudden, much more severe economic growth slowdown.
But they would have thought of that, Tim.
I think so. I mean, the Fed takes all that into account, and I would agree that particularly consumer inflation expectations really don't have much predictive power. Market-based inflation expectations, which is what I tend to rely on, their predictive power isn't great, but you kind of have to have something, I suppose, if you're trying to set policy kind of out the front windscreen as opposed to the rear view mirror. And so as long as they're stable, and I think that's the key point here, is something like five-year forward inflation expectations have been very stable around a range that was low relative to the pre-GFC norm. So that tells me things are contained. And then again, if you look at the labor market and look at wage pressures, because that's, in my view, where inflationary impulses have to come from at this point. Yes, things will ease up now. The labor market potentially, well, I think the Fed hopes, will start to heal a little bit, or start to, the weakening we've seen will maybe start to reverse. You might get some wage pressure there. I'm very open-minded to that, but so far, you don't seem to have too big of a de-anchoring risk.
Okay, Tim and Mark, thank you so much. Both stay with us now. The Bank of England is likely to decide against cutting UK interest rates for a second straight meeting, maintaining a pretty patient approach to reversing the most aggressive policy tightening in decades. Well, joining us now from outside the BOE is our UK correspondent, Lizzie Burden. Lizzie, when you look at what we heard from the Fed and the gravitational pull from the Fed, I don't know whether it nudges the BOE to do anything.
Well, Francine, if you look at the bets this morning, they've barely budged post Jay Powell, so it doesn't look like things have changed. Why? Well, they'd already priced in the expectation of a half-point cut from the Fed when all the hints were dropping in the Journal and the FT. And you could look at it another way. You could think of it as Jay Powell doing a bit of the work for Andrew Bailey. And he did actually manage, it seems, as you were just discussing, to land that message about a soft landing. So it would appear that the BOE has less to fret about, perhaps. The other reason why they're likely to hold today is that services spike in inflation yesterday. That is something that the BOE has flagged as a concern. And of course, at Jackson Hole, we had this cautious tone from Andrew Bailey. So the expectation among economists remains that you're going to have a cautious hold today, with actually a less finely balanced split than last time. 7-2 is what we're looking for, with a particular eye on Alan Taylor, the new member of the Monetary Policy Committee, and an eye on quantitative tightening, the pace of asset sales. Do they ramp it up from £100 billion? Would be consequential for the new Chancellor, Rachel Reeves, at her budget on October the 30th. But again, the expectation among economists is largely that they're going to keep it on hold.
Lizzie, thank you so much. Our UK correspondent there, Lizzie Burden. Tim, when you look at, what markets are expecting, I mean, they're hoping Andrew Bailey to provide some kind of hints on what happens in November. He's always pushed back against market expectations.
Yeah, but I think now, as was mentioned, the Fed kind of gives him some runway to maybe be a bit more easy. And when it comes to the Bank of England, I come back to how rate markets are priced, and particularly now how they're priced vis-a-vis the Fed. Before yesterday, markets were priced for rates in the US to get to neutral. They were priced for the UK to stay tight for the next 3 years, which to me is crazy. That suggests that UK monetary policy will be tight at that point for 4 to 5 years. I don't see that happening, not with the rest of the central banking community globally, whether it's the ECB, the Fed, the S&B, whoever you want to point to. It's getting easier, and the UK being an outlier from that, I don't think it's that insulated that it will be able to resist that pressure for too long. Not this meeting, but future meetings for sure.
Mark, I mean, we did hear, of course, from Andrew Bailey at Jackson Hole again saying that, rate setters need to be very cautious because the job is not complete when it comes to inflation. He signaled that there's growing confidence, I guess, that some of the second-round inflation are smaller than expected. But is this, the market is running with another narrative. And do you think we have the data to support what they're trying how they're interpreting what's coming out of central banks?
I'm with Tim that I think that, the pricing for the UK is too cautious. I mean, to me, it seems bizarre that, as Tim points out, we're pricing US rates to be slashed aggressively while UK rates are staying high. Now, this year has shown that we can slightly decouple in terms of the rate cutting cycles. They don't have to be obviously simultaneous. And I know UK has had some sticky issues, but the US economy is much stronger. Look, full year inflation for the US will come in higher than the UK this year. Full year growth in the US will come in at least twice the level of the UK this year, even though it's been an improving outlook. And yet, it's the US that's cutting rates, not just by 50 basis points, but also pricing another couple of cuts before year end. And yet, we're tentatively talking about UK cutting before year end. Ultimately, 2-year yields in the US trade below the UK. I don't think that's a sustainable situation. I think over the coming 6 months, that will unwind. I think 2-year yields have upside, and UK 2-year yields potentially have downside. I think it can actually work from both directions, but I do think the 2-year yields are too aggressively priced, and definitely they can't both be right. The relative trade there is just completely off.
No.
Totally agree. I think that's one of my views for the next year is pay UK rates, receive US rates. Even though I think the US rates curve probably has a little bit more to even be priced in. You need to price a probability of a harder landing in the US, and I don't think that's actually in the pricing. But that doesn't matter vis-a-vis the UK, because that pricing is clearly not there for the UK. It is priced to remain tight for 3 years, and that strikes me as just off the charts crazy.
Off the charts crazy. There you go. CFA level 5. Yeah. Thank you so much, Tim Graff, head of EMA macro strategy at State Street Global Markets. I'm Mark Cudmore, Bloomberg's Markets Live executive editor. Coming up, a new wave of exploding electronic devices in Lebanon ramp up tensions between Israel and Hezbollah. We have the latest from the region next, and this is Bloomberg.
What's happening on Wall Street?
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show.
So let's talk about one. Here's a question that's near and dear to your heart. You have a lot of children.
Yes. I'm trying to set a good
example. The birth rate is down in the U.S. What needs to change so people start having more children?
Yeah, so this question has troubled me for a long time because you can look at the demographics. It's a very slow-moving ship. I mean, you know who's going to be an adult in 20 years based on who was born last year.
So, and now, if you want to, I think, have a good approximation for population, really look at how many babies were born last year in a particular country, multiply that by life expectancy. That's the number of people that will be adults in that country. That's the steady state population if birth rate remains constant. Now, birth rate is not constant, it is dropping. So you look at the second derivative of birth rate, and actually we see an acceleration in the drop in the fertility rate. Second derivative of the fertility rate is very bad. So where does this lead? This does not lead to a greater civilization. This leads to a civilization that potentially dies not with a bang, but with a whimper in adult diapers. That is a sad ending.
So obviously we have countries that, like Korea, used to have a birth rate of 6, it's now 3/4.
Yeah.
Here's a light question for you. What do you
come pick
think
me
are
up,
the
I'll
biggest,
give you a baby, says one
what
of
do you
the...
think are the...
That is one of the things that says on the screen.
Yeah. I don't know if everyone heard that. You want to read it?
It says, Elon, come pick me up, I'll give you a baby. Thank you.
Okay.
Well, I mean, I certainly encourage everyone in this room to have at least 3 children. Look, baby's got to come from somewhere, you know. And I think we just want to have, I don't know, I think we want to have like a slightly increasing population, not a plummeting population. You know, and I think this applies to all countries and cultures. Like, I don't think we want any country or culture to disappear. We want them to ideally flourish and not disappear. So, in fact, one of the things that is overlooked by probably most historians is the role of low birth rate in the decline of civilizations. So around, I think it was around 50 BC, Rome passed a bill to give a bonus to any Roman citizen that would have a 3rd child. So this was birth rate was a problem in Rome in 50 BC. The Romans weren't making Romans. The same is true of ancient Greece. So there was a time from about 800 BC to 300-ish BC where the Greeks had a lot of kids and a lot of surviving kids. Like the birth rate far exceeded the death rate, which is why you had Greek cities popping up all over the Mediterranean. But then I think basically it seems to be that prosperity destroys the birth rate. So when a civilization feels like it has no meaningful external threat and is very prosperous, that is what causes the birth rate to plummet. Somewhat counterintuitively, you think, well, if you've got more resources, surely that would lead to more kids. In fact, it is the opposite. The more prosperous a civilization, and the more a civilization feels that it does not need to defend against external threats, the lower the birth rate.
Of the Israeli defense minister talking about potential redeployment up in the north. You've also had comments from the Iranian envoy to the United Nations. He sent a letter saying that Iran reserves its rights under the international law to take required measures deemed necessary to respond to such a crime and violation. Why is that letter being put forward from Iran? Because also, just a reminder, on Tuesday, the Iranian ambassador to Lebanon was also injured in that pager explosion attack, and therefore there is a risk of this becoming a broader regional conflict.
Jumana and Paul, thank you so much for joining us. Jumana Borseche in Dubai and Paul Wallace in Tel Aviv. Much more to come, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Well, Bloomberg has learned a large group of secured creditors of Altice France have sent the company a proposal to fix its €24 billion debt pile. Now, the plan raises the possibility of billionaire owner Patrick Drahi losing control of the embattled French telco. We understand it's unlikely to be accepted by the firm. Boeing's largest union says mediation with the plane maker concluded today without reaching a resolution to an ongoing strike. Now, it comes as Boeing moves to require some workers to take unpaid leave to preserve cash during contract talks. U.S. workers face a week of unpaid leave per month as the strike continues. Coming up, we'll be joined by Catherine Nice, Chief European Economist at PGIM, for more on the Fed's first rate cut in 4 years and a look ahead to today's BOE decision. More on that next, and this is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Well, good morning and welcome to The Pulse. I'm Francine Acqua here in London, and these are your top stories. The Fed goes big. Stocks rally after an outsized cut in U.S. interest rates, but Chair Jay Powell cautions on the speed of further easing.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen.
The BOE is next. Economists expect UK rates to stay on hold, but will the Governor Andrew Bailey hint at a reduction in November? And Israel declares a new phase in the war with regional Islamist groups as Lebanon is hit with a second wave of exploding electronic devices. Now back to our top story, and the Federal Reserve's bold start to cutting interest rates has reshaped the policy horizon for counterparts across the world. Now attention shifts today to the Bank of England, where we'll get a rate decision in a few hours. Now for more, let's bring in Catherine Nice, Chief European Economist at PGIM Fixed Income. Catherine, as always, thank you so much for joining us, especially on what feels like a very big day. They cut by 50 basis points. Is it because they were behind the curve?
I think so. I mean, I was a bit surprised, I have to say, back in July that they didn't cut 25 basis points. If we look at inflation on a comparable measure to what we're seeing in Europe, of course, I'm always looking at this from a European lens, inflation in the U.S. is actually lower than in Europe. And they are, one of the last, if not the last, major DM central bank to be cutting. So I felt that they should cut 25 basis points in July. Since then, the economy has softened. So perhaps it's not surprising that they've gone kind of all in for the 50 here now in September.
So, Catherine, what are they worried about? Are they worried? I mean, is this a cut into a possible recession that they're trying to make a slow, a soft landing, or are they just trying to prop up the labor market because they don't worry about inflation?
So my sense is that the recession outlook is a risk. It's not the base case. Clearly, as inflation has come closer to target, they have pivoted. They have a dual mandate to focusing more on the labor market. And I think what they're really trying to engineer here is basically a second leg of this soft landing to be able to, underpin that easing in the labor market to make sure it doesn't overshoot and tip into a recession, whilst keeping a gradual path for interest rates going forward to make sure that inflation remains contained.
So what happens next? The messaging from Jay Powell seemed to be pretty clear, is that they're going to go gradually from here. There was a bit of market repricing. Where do we end up by the end of the year?
I mean, I thought that the Fed handled the comms really well. I think there was a risk that they could kind of spook markets by going 50. It could have a bit of a whiff of panic. But they really clearly messaged that from here on out, the cuts are gradual, and moreover, that they're going to end up at a higher level with that revision to the long-term DOD to really, hammer home that this is just a recalibration in the level. So I think what they are trying to engineer is a continuation of this soft landing. And so I think as long as the data do not really materially deteriorate from here, then I would expect them to really follow this gradual path that they have signposted.
So, Catherine, when you look at some of what happens next in terms of treasuries, what are you interested in?
So I think although it's not a base case, I think the risks of a substantial weakening are there, and moreover that tips into inflation. So I think there is a growing risk, perhaps a little bit more in Europe than in the US, that we could see inflation undershooting the target, and that we get, not a return to the pre-pandemic decade, but, a bit more of a flavor of that. And so, I think the next big question is, do we really think that that long-term endpoint is significantly higher than where it was before? Maybe the market is going to test that a little bit, and we see that come down further. But, that's all to play for.
So you're not, I mean, when you look at the worst case scenario, is that basically there's big fiscal, stimulus spending from whoever comes into the White House, and actually we're underestimating the stickiness of inflation in certain parts of the U.S.?
On the fiscal, I think, my expectation is whatever the outcome of the election, that the impulse is probably going to be broadly neutral. Okay. I think it might be difficult to test whether there's appetite to actually increase fiscal from here. It's already pretty healthy slug of fiscal spending going in there. So to increase it further from here, I think would be hard. So my expectation, it's going to be broadly neutral. And so, I'm not expecting any kind of sort of strong reaction to kind of market concerns over fiscal. That's, again, a tail risk. But really, it's just about, has this long-term endpoint for neutral really gone up relative to the pre-pandemic period? I think that remains to be seen, and there could be some question marks around that, especially if the data keep coming in soft.
So, Catherine, what does a 50 basis point cut actually mean for the BOE today?
So I don't think it means very much for the BOE today. I mean, I could be proven to be wrong, but my guess is that they're still on track to, buck the trend and be on hold, so not follow the ECB or the Fed. But where I think it does matter is once we get to the early part of 2025. I think this does help enormously other central banks. It takes a lot of the kind of spillovers of this U.S. exceptionalism that was quite tough for the rest of the world, takes a bit of the heat off, and it does open the way for them to be able to more aggressively cut once we get into the early part of the new year. But just now, I think it's a bit too soon. Like the Fed, they're going to want to message that they're on a cautious cutting cycle for now.
Market pricing for Fed cuts and the BOE cuts seem to be off. The BOE has one mandate, the Fed has two. But actually, if you look at the strength of this economy, some of the concerns, would it warrant more cuts than priced in the markets?
I can see it looks strange. How is it possible that the ECB and the Bank of England are more cautious in terms of cutting when clearly their economies are significantly weaker than the U.S.? But I think we have to remember, first order, the inflation shock was different. In the U.S., it really was, a more kind of domestically generated boom because we had, very strong fiscal and we had very easy monetary policy. Whereas first order in Europe, including in the UK, the inflation shock was really because of events that were external. Right. So it's harder for European policymakers to control inflation. We just have to wait for this inflation shock to work its way through. It's on its final leg, we think, via services and wages. They just want to make sure that they've completely stamped it out. So it makes it look like they're a little bit behind the Fed, whereas in the U.S., we are seeing the cyclical weakness, inflation's coming down, so they can be more reactive. And of course, then there's the mandate difference. But I think it's more that inflation shock itself was different in the two regions.
Yeah, and I guess the fiscal impact, the October budget could significantly change things. I know that Governor Bailey keeps on pushing back against that, but actually the economic landscape will change for the UK. What does it mean for your appetite for gilts?
I think, it looks to me like Chancellor Reeves is very much setting us up for what I call a swallow the frog a budget. She's going to front load the pain. Yep. And, that combined with the U.S., cutting now more aggressively, at least with its first cut, and then signaling further cuts, I think that is going to make it easier and pave the way once they get through this, wage setting round into early 2025, they can cut rates. And like the Fed, the UK is quite some way away from neutral. So once they are on that more confident path that inflation's coming down, I think they're going to cut quite aggressively. And, the end game here could be something that, doesn't look too dissimilar from the Fed, around 3%.
When you look at the world globally, what's your biggest unknown? Is it China and how China performs, or is it the price of oil that, frankly, has been quite helpful at the moment? It's almost like an extra stimulus for the world economy, but we don't know what happens next.
So I would say two things. One is, we've just gotten so used to the narrative about being high inflation. Do we really need to think and worry about deflation coming from China, the weakness in China, the weakness in energy prices? Again, those things are external, harder for policymakers at home to respond to. And I think the second thing is, this quantitative tightening, this balance sheet contraction, central banks stepping back from buying sovereign bonds happened during a time when rates were going up. So there were ready buyers. But are we going to see that if we see a continuation of QT with rates coming down and coming down quite sharply? Are we going to see a ready buyer? I mean, many people have kind of cried wolf on this point a long time, so, I don't want to overemphasize it, but we just haven't lived through that experience. So that's something for me that's like a bit of an open question for 25.
Catherine, as always, thank you so much for joining us. That was Catherine Nice, Chief European Economist at PGIM Fixed Income. Now, coming up, car sales take a hit in Europe's biggest market. More on that and the EV demand story next. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Welcome back, everyone. Commerzbank looking to speed up the process to replace its chief executive, Manfred Knof. It comes as the German lender prepares also to respond to a surprise move by UniCredit, which this month disclosed that it built a 9% stake in Commerzbank and indicated it may seek talks. Now let's bring in Stephen Ahrens, who leads Bloomberg's EU finance team in Frankfurt. Stephen, thank you for joining us. Who's in the running to be the new Commerzbank chief executive?
Hey, so definitely the CFO, Bettina Orlopp, who's also a frequent guest on Bloomberg TV. She is seen as a strong contender. She's the one internal candidate that's, I think, got a strong claim to the title. She was passed over, actually, for the role 4 years ago, we've reported. But we've also reported that they are looking for external candidates and have mandated a headhunter to help them with the process. So it could also be someone from the outside.
So how does this search for a new chief executive also play into the move by UniCredit?
Well, it's kind of a weird one. So Knof, the CEO, the current CEO, literally said he was not seeking a renewal of his current contract, which runs out at the end of next year. He said that one day, on the night, essentially, that this became public. And so that has added another layer of uncertainty for UniCredit how to respond to this, because with the CEO sort of saying he's going to be gone at some point, obviously that hasn't turned him into a lame duck yet, but it sort of raises the question, how soon will he be a lame duck? Can he lead the defense strategy that Commerzbank is working on? Can he lead the talks with Ogel, his counterpart at UniCredit? So I think it is sort of in the interest of many people to settle that uncertainty fairly soon and make sure they have a strong leadership in place to guide Commerzbank through a pretty, rough environment in the months ahead.
Steve, when you look at some of the things that's been said, how are actually the German press reporting on this? Are they worried that there's still UniCredit lurking? Or have they asked Deutsche Bank to step in? What's the general zeitgeist on this?
It's an interesting one. So obviously the first reaction was shock. I mean, at least surprise, and in some corners also shock, because no one expected UniCredit to step in. As you probably know, the interest of UniCredit in Commerzbank has long been reported, including, of course, by us, for many years. But no one thought Ogel, the UniCredit CEO, would swoop in, would use the stake sale by Germany to swoop in and take a major stake in Commerzbank to sort of set up himself for a potential takeover at some point. So that's shock. Some people privately say, why not? If you look at the profitability of Commerzbank, it's much lower than UniCredit's. Ogel at UniCredit has done an outstanding job turning the bank around. It used to be a really weak one too, and now it's one of the strongest in Europe. So many people say if he can do it at UniCredit, maybe he can do it with Commerzbank too. So there's that too.
All right, Steve, thanks so much. Stephen Ahrens there in Frankfurt. Now, staying with Germany, and the country has led a drop in European car sales. Deliveries were dragged lower by electric vehicles, which plunged 69% in the year to August in the region's biggest car market. Now, joining us now for more is Bloomberg's Oliver Crook in Berlin. So, Ollie, more bad news from the auto sector.
Yeah, Francine, with demand squarely in focus in the auto sector, I'm sad to say you didn't get any good news from the August figures we got from the EU car deliveries. As you can see across the board, across Europe, sales were down 16.5%, led by which markets? The most important markets, by Germany, by France, down almost 30% in Germany, down 25% in France in the month of August, down 13% in Italy. This figure wipes out the year-on-year growth for the year-to-date from the auto sector within the Europe sales for both of these countries. It's still up a little bit across Europe, but if you switch up the board and take a look at how this has been faring in terms of the actual companies involved, you see that you have sort of Volkswagen sales down 13% in August, Stellantis down almost 30%, BMW down 15%, Mercedes down 10%, and Tesla down 36% in the month of August. All of this coming as we've been reporting on some of the issues at BMW with some of the recalls, and of course that sort of bombshell news that Volkswagen is thinking about closing factories within Europe. But Francine, it's not just in Europe. Volkswagen will also be closing some of its factories in China in its partnerships with SAIC, which is another sort of very poor omen in terms of global automotive demand.
So what more are we learning about the shift to EVs?
Well, listen, if you're wanting to find good news, it's not in the EV market. If you look at the numbers there, they're even worse than what we saw across the board. I mean, EV sales in the month of August, year on year, down 36% across Europe. If you look at Germany, down almost 70%. France, 33%. And in the 70% out of Germany, this has in part to do because some of these incentives that existed last year, so the comparable base effect of last year, August, was very, very brutal. But as you can see, EV sales down 70% in Germany. The one bucking the trend, Francine, is the United Kingdom, up 11%. That's also mirrored by what we're seeing in terms of the year-to-date trend within the UK, which is also up 11%. If you look across all of the different categories here, you see petrol was down 18% in August, battery EVs down 36%. The big winner, Francine, it's the hybrids, the things that are sitting right between that transition between EVs and combustion engines, up 20% year to date. And of course, this has huge impacts in terms of kind of the questions about EVs going forward. There's a lot of people in the auto industry that say that there's a mismatch between what policymakers want and what the market wants right now. And also, if you look further down the value chain, this is also going to have an impact on the chip sector because all of those chips that they're supposed to put into those EVs, which take a lot more chips than other cars, with the demand coming down for EVs, that's going to hit the chip sector too.
Ollie, thanks so much. Oliver Crook there in Berlin with the very latest on some of these hybrid demands. Now, coming up, the yen slumps against the dollar after the Fed's jumbo rate cut. We'll discuss that next and what we should expect from the BOJ at their next meeting tomorrow. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Here's the headline. Fed cuts interest rates by 50 basis points and the bond market returns are going to be negative today.
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about.
The market's going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
We would have liked to have seen the median dot for the end of next year somewhere around 2 3/4 to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you 250 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good.
Some of Bloomberg guests there on the Federal Reserve's first rate cut in 4 years. Now joining us for more on central bank moves is Ven Rand from Bloomberg's MLive team. Ven, thank you so much for joining us. What did you make of the cut? I mean, 50 basis points was bold, but actually the market was okay with it. So does it point to good communication or a blurriness about what happens next?
Well, I think that it comes down to good communication, because at the Jackson Hole address, Powell was extremely dovish, and we had those media leaks going into the meeting as well. So that set the markets up to expect a larger move. So which is why you didn't see a vehement reaction in the markets, albeit it was interesting that stocks could not hold their gains. So that speaks to a market that thinks that, look, the economy, we are well past the best buy date on the economy, on this economic cycle. So I think that the markets are a bit jittery, especially considering how much stocks have run up. I think that the 2-year Treasury yield has room to rise, because we had fallen 120 basis points so far this quarter. That kind of phenomenal rally hasn't been seen outside of periods where the economy hasn't been in great distress. So I think there is room for modest repricing here.
Ven, what do you think is most off? I don't know whether we get a curveball actually from the Bank of England today, because if you look at pricing for Fed expectations of the Bank of England and you look at the respective economies, a lot of people just say it doesn't make that much sense.
Yeah, it doesn't make much sense at all. I think that the Bank of England has room and scope to go much faster on rate cuts. I think the room for them to cut rates is 250 basis points if you pass the Taylor rule. So there is plenty of room. There's no question about it. What makes today's decision interesting is the fact that we've got a new member on board, Alan Taylor, who is supposed to be more dovish than the previous Jonathan Haskell, who is replaced. So I think that, you know, it's going to be a closer vote than the 7-2 split that the markets are expecting. And of course, Bailey has previously said that the markets are underpricing the risk of how fast the BOE can cut rates. So with those two caveats, we enter into this meeting. Let's see what it brings.
Well, what do you think, then, is most interesting? I mean, there are a million questions that I have for you, but a limited amount of time. There's a BOJ, of course, tomorrow. I don't know whether the gravitational pull from the Fed changes anything there.
Well, I think that, the fact that we've got an LDP election coming up by the end of this month is going to overshadow everything else that the BOJ does tomorrow. I would be extremely surprised if they hike. I don't think there are virtually no expectations that they will do anything of note. I think what will be key for the markets is whether they flag another hike in October or in December. I think that the markets are extremely complacent about when the BOJ will hike next. Not much is priced into the curve yet, but I think that the neutral rate in Japan is about 1%, and they will get to it because the economy is doing pretty well and inflation is ticking higher as well. Those wages are shaping up to be pretty firm. So I think there is very little incentive for the BOJ to just stand pat, albeit that's what they will do tomorrow.
Okay, Van, thank you so much. As always, Van Ram. I just got a note by Kid Jukes, which is very funny, saying there are disadvantages to putting a lawyer in charge of central bank, but one advantage is the ability to make a 50 basis point cut sound like a hawkish move. Now, coming up at 12:45 p.m. London time, we'll be speaking with the U.S. Transportation Secretary, Pete Buttigieg. That's on Bloomberg Surveillance. Up next, a Bloomberg Brief with Danny Berger in New York, and this is Bloomberg.
Make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street.
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Good morning from our global headquarters in New York. I'm Danny Berger. Manish Cranny is on assignment. Welcome to Bloomberg Brief. Let's set your agenda. The jumbo unwind. The Fed opts for a 50 basis point cut, ending a historic tightening cycle. The global stock rally gathers pace. Treasury steady after a sharp post-Fed surge. Gold climbs back towards record highs. And two more decisions to go this week. The BOE and the BOJ are on deck. So we got it. We got the big boy 50 basis point cut, 11-1 decision, the first dissent since 2005. The justification seems to be we're going at 50 because we can. Inflation has been vanquished and the labor market is strong. The language Powell used is our commitment to keep the labor market there. Now, it's because of that the reaction yesterday perhaps wasn't what you would expect with a 50 basis point cut. Stocks were weaker, yields were higher, and the dollar was stronger. Good news, a lot of that is reversing this morning. The two-year yield down by 3.5 basis points. We're still pricing in maybe a 30% odds of a 50 basis point cut in the next meeting. It is off to the races with the risk appetite this morning. Again, we've undone some of that bearishness. Up 1.3% in the S&P 500 futures session. Russell 2000 futures also really, really strong this morning. 2.5% is where we stand on the Russell. It is a bull market reinvigorated from yesterday's cut. Also, the dollar weaker. Again, all those moves post-Fed being unwound. Euro stronger versus the dollar by 0.4%. A little breaking news to bring you as well. The Apple is facing an EU warning to open up iPhone operating systems. Again, we're going to keep track of that. It is an EU that has been very active when it comes to antitrust action. We've had a few court rulings recently, too. Apple's still higher pre-market. This probably has more to do with the Fed, up 1.4%. But again, the Apple story is they are facing an EU warning on their operating system, the EU telling them they need to be opening it up. Okay, back to the Fed. It is the end of an era. The Fed pivots, but no commitment for further cuts this year.
A broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
Joining us now is Bloomberg cross-asset strategist Ben Ram. Ben, those were the words from Powell. I just want to walk through some of the market reaction because it's been quite the past 12 hours. So you first get a Powell who says you just read this as a commitment not to fall behind the curve. You see Treasury sell off, as do risk markets. But this morning, it's reversing. I know you had really acutely called that two-year yields would rise after the Fed. They did, but now they're lower. Just what do you make of that back and forth?
I don't read too much into what is happening this morning, to be honest, Danny, because look, I mean, what is the state of play? I mean, we've got an economy that is losing momentum, but it's nowhere toppling over at the moment. Many of the markers in the labor market and indeed the wider economy are suggesting that the US economy is holding fine. So this is a preemptive cut. This is reflective of a Powell who wants to ensure a soft landing. So if you juxtapose the Treasury yield moves against that, 120 basis points on the quarter is overdone. You have never seen that kind of a drop outside of an extremely systemic scenario distress kind of situation, i.e. during the global financial crisis or during the initial wave of the pandemic or during the bursting of the dot-com bubble. Outside of those periods, there's not one segment where Treasury yields have fallen so much. So we are overbought, extremely overbought on Treasuries. And let's also face that, you know, the Fed has penciled in a neutral rate of 2.9%. That's where they will get to by 2026. Now, if my own Taylor reading, pausing of the Taylor reading shows that the rate will settle somewhere around 320, which is more realistic. Given all that, if you look at the 2-year yield at 358, it doesn't make sense. It needs to be somewhere around 375, 380. So it's a mild correction that we will see in the coming weeks.
Yeah, and that 2.9, I think we're priced to get there somewhere in the next year, basically summer of next year. Ven, also worth pointing out that gold is 1% higher this morning, trading around those record highs. What do you make of the moves there?
Well, on the 2.9%, I just want to say that's what the Fed's median rate cut showed, and not the market pricing. On gold, look, I mean, as long as the Fed keeps its promise of cutting rates, I think that gold has great convexity. It's going to push higher. And if you not discounting ignoring what's happening with the dollar this morning, if a lower dollar is going to push the gold prices higher as well. So my analysis suggests that gold will reach 3,000 if the Fed cuts rate by anywhere near what its dot plot show.
Okay, Ven, thank you so much. That is Bloomberg's Ven Ram. Let's cross over now to Jane Foley, head of FX strategies at Rabobank. Jane, I want to get your take on some of these market moves, but first, just your overall thoughts on the decision and Powell's language yesterday.
Well, clearly, the economists got it wrong, and the market sort of was more right this time. But I think what we had in terms of the reaction, it told us an awful lot about market positioning. We had a very straightforward sell on the fact type of reaction in the dollar and in stocks, and I think that is now balancing out this morning. I think a lot of people in Europe would have come in this morning and looked at the prices and actually seen opportunity there, and clearly that's what's playing out today. But there was no panic, and that was perhaps a nod really to the economists' view that 25 basis points would have done. There was no panic this time around. Powell clearly just said he wanted to recalibrate that, bearing in mind where the labour market was, where inflation was. Rates just could be a little bit lower, 50 basis points lower. Unfortunately, we don't have European central banks in such a comfortable position. There is more inflation, there is more tightness in the labour market, there is more worries about wage inflation, services sector inflation. So unfortunately, that comfort with the labour market does not necessarily translate into the Bank of England, into the ECB, at least not just yet. But certainly, a pretty good position, I think, for the US economy to be in.
And to that point, Powell reiterated that over and over again, Jane, that this is a strong economy. It is a strong labor market. He said this time to support the labor market is when it is strong and not when you begin to see layoffs. That does seem like a change in tone, that they're not waiting for the labor market to weaken. They're trying to get ahead of it. Did you come out with a clear and different view of the reaction function and just understanding on where we go from here?
Well, it's difficult perhaps, to be a little bit skeptical or not to be a little bit skeptical on the political angle here. There is an election coming up. Powell's perhaps doing a little bit more than he needed to do in terms to support the economy ahead of that election. Was that politically motivated? I'd really like to say no, of course it wasn't. But, that doubt does begin to creep in. But, the US labour market has a lot more advantages in many respects. To say the European labour market, it is more flexible. There is a high level of productivity. There has been high levels of immigration. And all of those things should help bring down the inflationary risks connected with the labour market. Unfortunately, in Europe, it's a much less flexible labour market. You do, of course, have less productivity across Europe and across the UK than in the US. And those sorts of things indicate that there is more of a breeding room, if you like, for inflationary forces. And I suppose, Powell was able to look at the US labour market in that sort of light and be far more relaxed about the ability of the labour market to produce more inflation.
Even if it is a better inflationary picture in the U.S., you still have an American economy that is growing quite strong. The Atlanta GDP tracker, something like 3%. So on rate differentials, I understand why the dollar would be weakening versus the euro this morning, but how does that contrast with growth between the two regions?
I think this is a really interesting question, because I actually think that the euro has been remarkably resilient this year in the face of not great fundamentals. Now, clearly, you've got countries like Spain, going very rapidly. But if you look at Germany, it really is struggling to move out of that stagnationary cloud. And those headwinds are, still very much there. We could see potentially a technical recession again for Germany this quarter. And so from that point of view, that the arguments in terms of growth are there for the ECB to loosen. But it is that stickiness in services sector inflation, which means that it has to be, really quite cautious about this. And that's sort of bad news, if you like, for many German exporters. If that translates to a more resilient euro, that's just another piece of bad news for these German exporters. So, from that front, I think Europe is certainly in a poorer position.
Jane, I'd be remiss if we didn't talk about the yen, which we're actually showing on the screen right now, ahead of a BOJ decision. How much more of a relaxed place does it put the BOJ in? The BIS came out with their quarterly basically saying the carry trade unwind hadn't happened, but you're witnessing this risk rally and not really any fear of that with the yen that is weakening this morning versus the dollar. Just how does that set us up into tomorrow's decision?
Well, tomorrow's decision isn't really about tomorrow's decision. It's first of all, is October a live meeting? And if October's not live, well, could they be hiking in December? Now, I think the data that we've had this week from Japan suggests that probably October is not going to bring an interest rate hike. But certainly, December could do and perhaps should do. And I think what the market wants is just some more pointers into validation, really, of that point of view from the Bank of Japan tomorrow. Now, clearly, dollar yen has moved an awful long way, and that sort of suggests a little bit of tightening has come back into Japan as a result of that. Now, that at this stage probably isn't unwelcome. It's probably quite welcome because I think the yen had weakened far too much when we were up at 160. But at the same time, the Bank of Japan probably don't want a rapid move down, to 130, 120 and beyond. So perhaps a more pragmatic statement tomorrow, perhaps to try and keep dollar yen where it is for the time being. But I think the market will continue to expect an interest rate hike from Japan, probably around about the turn of the year.
Jane, we really appreciate your time this morning. That is Rabobank's Jane Foley. Let's get you some other top stories that are trending on the terminal this morning. U.S. authorities have accused Iranian hackers of emailing stolen information from Donald Trump's campaign to President Biden's campaign team and to journalists. The operation happened in the summer before Biden left the race. Investigators don't have any evidence that anyone from the Biden campaign replied to the emails. Elon Musk's X skirted a ban in Brazil through a software update that changed its IP address structure. That's according to an association of Brazilian internet providers. Access to the platform returned abruptly overnight for many Brazilians. X was blocked last month in Brazil by a Supreme Court judge. Descendants of the Rothschilds banking dynasty paid around $100 million for a vineyard that they bought from the billionaire Pinot family. The vineyard is in the Chablis region of France. Even with competition from abroad, it's clear France's top-rated wine estates are still attracting a premium. Coming up, walkie-talkies explode in Lebanon. Israel says it sees a new phase in the regional war. We're going to have more on that for you next. And we'll catch up with State Street's Marvin Lowe. He's keeping his expectations for QT into 2025, as did the Fed, so no reason for any change there. He's going to join us later in the hour on Bloomberg Brief.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow.
And these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What I can tell you is we were not involved in yesterday's incidents or today's in any way, and I don't have anything more to share. It's too soon to know if what happened over the last couple of days is going to have any effect on where we are with the ceasefire deal. Sadly, we aren't any closer to that now than we were even a week ago.
That was the U.S. National Security Spokesman John Kirby speaking after deadly blasts in Lebanon, being very stark about his remarks. The Israeli defense minister declared what he called a, quote, new phase in the war with regional Islamist groups. Israeli troops are being diverted to the Lebanese border, raising fears of a wider conflict following 2 waves of exploding devices which killed 32 people in Lebanon. For more, we're joined by Dana Krish, who leads Bloomberg's breaking news coverage in the Middle East. Dana, great to talk to you this morning. What do we know about this new phase?
Hi, yes, so what we heard from Gallant yesterday is that they are now focusing more on the security threat and the northern border in Israel. And we heard him say that the center of gravity is now moving there. So they're moving troops, their capabilities, their resources onto the northern border to focus more on that threat and what they can do to eliminate it. Israel has been preparing for war with Lebanon even before October 7. Hezbollah has always been seen as the greater threat here. And the U.S. seems to be still trying to avoid an escalation in the region, to avoid another war that would be very devastating for the Middle East and the countries involved. And it could actually just drag the U.S. and Iran into it as well. So the U.S. effort seems to be continuing, but Israel has always been and still is adamant on returning thousands of people who left from the northern border and is now focusing more on that and seeing how to eliminate this threat.
Dana, it feels like one thing that we've stopped talking about was this idea that Iran would retaliate for what happened in the ground there with the Hamas leader being assassinated. I know in these explosions that its ambassador to Lebanon was seriously injured, and Iran said that it reserves the right under international law to take required measures deemed necessary to respond to such a heinous crime in violation. Where do we stand on this specific concern of escalation between Iran and Israel?
It seems it's still there. What we've been hearing from Iranian officials, and even today, actually, in Iranian media, is that Iran hasn't forgotten about the assassination of Ismail Haniyeh and that they will respond. In terms of what's been happening in Lebanon, I think they would leave it for Hezbollah to retaliate or to respond, because that's their territory, their turf. And it's a major security breach, not for Iran specifically, but for Hezbollah. And today, the Hezbollah chief will have a televised address later today, and will probably say that they will retaliate just to calm things down, and especially that their supporters and members are angry and very shocked at what happened, because it is an embarrassment to the group.
What is the latest on the ground in Lebanon, Dana?
Yes, so we know from the health ministry there that at least 32 people have been killed and thousands have been injured. Most of the casualties seem to be from Hezbollah members, people who work at their supermarkets, anyone affiliated with the group. And this because of not just pagers. What we saw yesterday was that walkie-talkies, fingerprint devices, even solar panels in places where supporters live and where Hezbollah holds sway or has his own centers and offices there, exploded. And this is the security breach, and this is something that Lebanon and Hezbollah is still reeling from. It seems that Lebanon as a government and Hezbollah, of course, are blaming Israel, although Israel has not confirmed or denied this, but they are insisting that it was Israel. We saw Lebanon yesterday saying that they would lodge a complaint against Israel at the United Nations. But what we're looking at today is how will Hezbollah respond to this, and what will they do to try to avoid this new warfare, this new type of warfare that they're having to deal with. And this is, of course, if it is Israel, Israel is showing what it can do without even going to war.
Right, yeah, you'd have to imagine how tense things are, and looking at all these devices, things like walkie-talkies. Dana, thank you so much. Bloomberg's Dana Krish. Okay, let's get a quick check on markets before we head to the break. And for risk assets, it is off to the races. Even though equities fell yesterday, just look at the strength across the board. For the S&P, 1.5% higher. NASDAQ and Russell, both more than 2%. It is the small cap stocks benefiting hugely from a 50 basis point cut. Even though there are doubts on whether that pace will consider, maybe the thought is this morning, don't overthink it. You got the big cut. It's a bull market. Okay, coming up, it is the Taylor Swift effect on airlines. We're going to have more on that next on your brief.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bloomberg Brief, Danny Berger in New York. Time now for your front page news. Let's take a look at what's making headlines around the world besides the Fed. On the Washington Post, they lead with this. The House votes to reject a GOP bill to avert a government shutdown. So 14 Republicans joined Democrats in order to block Speaker Johnson's plan to fund the government for 6 months. That means that the funding for the federal government still expires on September 30th. Next up, this from the FT. Merger rules must help EU companies fight global rivals. That's what the new competition chief, Ribera, has said. Again, she was just appointed. She promised that merger rules will evolve to help European companies build scale to take on global rivals. She also said that she was in favor of cross-border scaling up. And then this one from us. I love this. Never far away from a Taylor Swift economic story. We had an interview with the chief commercial officer of United, who said that demand is swelling because of Taylor Swift's Eras Tour. Specifically, they see a 25% increase in demand, quote, maybe more than that, on United flights after Taylor Swift's weekend concerts, and then after that it goes right back down to normal. This is the quote from Andrew Nocella. Our demand booms wherever she goes. They haven't added flights for one of her concerts, but again, the chief commercial officer saying that they wouldn't rule it out. So, you know, the economics of Taylor Swift and all that. Okay, the economics of this bond market. The initial reaction was yields higher after the Fed's decision as Powell brushed off moves of this size. Again, maybe that was overdone. Maybe it was positioning. Yields on the 2-year lower by 4 basis points this morning. Coming up, we're going to catch up with State Street's Marvin Lowe.
Make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating And then you'd start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Manish Cranny is off in Houston on assignment. Let's set your agenda. The jumbo unwind. The Fed opts for a 50 basis point cut, ending a historic tightening cycle. The global stock rally gathers pace. Treasuries steady after a post-Fed surge in yields. Global gold climbs back towards record highs. And two more decisions to go this week with the BOE and the BOJ on deck. So we got it. We got the big boy 50 basis point cut, an 11-to-1 decision, the first descent since 2005. Why move by 50? The message was almost because we can. This is a commitment, Powell said, to not fall behind the curve. That initially meant a reaction of risk assets lower and bond yields higher. We get the opposite this morning. It is a reversal, and a strong one at that. Your S&P 500 futures up 1.5%. Small caps doing even better this morning. The Russell 2000 futures up nearly 3%. For the bull market, the read is don't overthink it, just buy. 10-year yields, those move lower, barely by a basis point, 3.69. Your 2-year yield this morning also moving lower, more significantly by 3.5 basis points. Bloomberg dollar spot, that is weaker. Asian FX, Asia dollar index at its highest, its most strong since July of 2023. The Fed opening the door for other central banks, and we have two more of them on deck. It starts with the BOE. That decision is today. Bloomberg's Lizzie Burden is down at the Bank of England on Threadneedle Street. Lizzie, what are we expecting?
Well, Danny, I'd love to tell you that it's going to be exciting on Threadneedle Street today, but look, the pricing's barely budged, even after that jumbo cut from the Fed last night. Why? Well, look, they already priced in a move from the BOE today to some degree when bets were ramping up of that half-point move from the Fed, when you're getting those hints in the Journal and the FT. And so after the decision, not much has changed. You could also argue that, to an extent, Jay Powell's done the work for Andrew Bailey today. And the fact that he's managed to land this message on a soft landing means that the BOE doesn't need to fret today. Also, if you hone in on the UK picture, yesterday we got this spike in services inflation, which is a cause for concern for the Bank of England. We heard from Andrew Bailey at Jackson Hole, particularly cautious. So the expectation from economists is that the Bank of England will hold today. It might be a cautious hold, but that the vote split is going to be even less finely balanced than last time. 7-2 is what we're looking for, with a particular eye on Alan Taylor, the new member of the Monetary Policy Committee.
So if no change is expected on the policy rate itself, what about QT, Lizzie?
Well, this is going to potentially be the interesting part of the decision. At the moment, the asset sales pace is £100 billion a year. There has been speculation among some strategists that they could accelerate that pace so that they can restock the arsenal in case of another crisis, because the pace of sales hasn't really been doing much to rock the market. But when we hear from the likes of Michael Saunders, the former Bank of England policymaker, he says, look, there haven't really been any signs that they are going to step up the pace. And so most economists reckon they'll leave it at £100 billion. Whatever they do, Danny, though, will be watched closely by the new Chancellor, Rachel Reeves, as she pulls together her budget on October the 30th, because, of course, the UK Treasury picks up the losses from that QT programme.
Lizzie, thank you very much. Looking forward to your coverage of the decision. That comes in about an hour and a half's time at 7 a.m. New York time. After the BOE, we still have another decision. We're going to wrap up the busy week of rate decisions with the Bank of Japan on Friday. Let's bring back in Ven Ram. Ven, great to see you again this morning. I know it's same kind of as the BOE, that this decision, not a lot is expected, but what could we hear about the potential path of policy rates going forward from Japan?
Well, I think that, if as you said, little is expected by way of decision, not least because we've got the LDP premiership election looming large by the end of this month. So virtually guaranteed that they will not do anything to rock the boat tomorrow. But as you said, what is going to be interesting is whether they tee up a rate hike either in October or in December. At the moment, the markets are thinking there is very little chance of a hike either in either of those months. But I think that the markets are complacent here to a degree which is unfathomable because, in July, we saw the Bank of Japan surprise the markets with that hike. And since then, UEDA has reiterated the message that, look, if the economy performs as forecast, and if inflation keeps ticking higher, as we have seen from those wage pressures, then the BOJ is going to be hiking rates. And how far will they go? They'll probably go until 1% at the very least, which has been bandied about by BOJ policymakers as the neutral rate. So the markets are underpricing all of that possibility. So at some point, those bets will come off and, the markets will sell off again.
I know this isn't necessarily a straightforward question to answer, Ven, but you look at the dollar yen this morning, and I mean, it's being moved by the U.S. quite clearly after that decision. What is sort of the bar for the BOJ to come in and do something like rapid appreciation, like we saw from their last decision? How do you sort of delineate what's going to be the bigger driver for this currency pair?
Well, I think the bigger driver is going to be the real interest rates, the real interest rate differentials. And probably a large part of that is going to come from the U.S. side of the equation because real rates in the U.S. are going to come crumbling down in the coming months as the Fed keeps cutting rates. So the bigger impulse will still come from the U.S. side of the equation, but the BOJ adding to those hikes will also narrow those rate differentials, pushing the yen up. Let's remember that the yen is extremely cheap even at current levels. Even though it's rallied a lot since July, it's still undervalued by a whole lot because if you look at the real effective exchange rate, the yen is terribly cheap and the cheapness has to correct.
Actually, Ven, now that I'm just looking at it, I just wonder what you do make of a cheaper yen this morning, considering against most G10 currencies, the dollar is weaker, save for the yen. I know this is a very short-term sort of look, but I just wonder what you make of that.
Well, I mean, it's hard to read into those one-day volatility measures, but I think that the longer-term trajectory is for the Japanese yen to head higher from here.
So, Ven, okay, let's take a step back because, yes, we have the BOE today, we have the BOJ tomorrow, but just generally for central banks. Now that we've gotten this 50 basis point cut from the Fed, what sort of door does it open up? What sort of policy action could we see more globally that perhaps was constrained previously, or maybe on the flip side, what kind of headaches does it cause?
Well, I would go back to the point about BOE. I think they have room to cut rates. If you look at the Taylor rule rate, the suggested rate for UK is 250, which means that the Bank of England has got 250 basis points of rate cuts still in the works because they are only at 5% at the moment. So 250 basis points of rate cuts means that they've got plenty of room to cut rates, and they will probably pick up the pace from November onwards, possibly from the first quarter of next year as well.
Ven, we really appreciate all your analysis this morning. That is Bloomberg's Ven Ram. Okay, a quick check on markets. Again, risk assets are just really off to the races this morning. They are priced in so strong, especially for Russell 2000 futures, up nearly 3%. The Russell 2000 was one of the few indices that ended higher yesterday, but basically unchanged because we had been expecting, or some markets had been expecting, 50 basis points of cuts. Powell poured some cold water on whether that would be the pace of future cuts to come, acting as if victory was in hand, and that's why they could cut by 50 basis points, but it was a more measured approach after that. S&P 500 future session up 1.5%. Bonds largely also reversing the moves of yesterday. Yields are lower on your front end of the curve, down by 3.5 basis points. 10-year yields basically by 1 basis point. And what we have is a situation where the long end is still under pressure. Powell was very clear that QT would be unchanged, that they could still unwind the balance sheet at the same time that they are cutting rates. So that's why you have some of that pressure on the long end that's sticking around. So your 2-year yield, 3.58, 10-year yield, 3.69, and 30-year yield, 4%. Okay, coming up, we're going to talk about the latest in D.C. We'll get the latest polls for Pennsylvania. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the U.S. We did that between different parties in Lebanon, in Sudan, and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Politics have been gridlocked, messy, horrendously partisan. And in my travels around the world, I find that America, the U.S., is in many ways stepping on its own agenda and not presenting ourselves with the urgency of clarity and policy and support that a lot of the world needs right now.
The former U.S. Secretary of State John Kerry speaking at the Gas Tech Conference in Houston with Bloomberg's Manus Craney, which is why you're only seeing me and not him as well. So Vice President Kamala Harris leads former President Donald Trump 50 to 46% in Pennsylvania. That's according to the latest New York Times Siena poll. It also comes as the International Brotherhood of Teamsters declined to endorse either candidate. The Teamsters General President said in a statement, "Unfortunately, neither major candidate was able to make serious commitments to our union to ensure the interests of working people are always put before big business. We sought commitments from both Trump and Harris not to interfere in critical union campaigns or core Teamsters industries and to honor our members' right to strike, but were unable to secure those pledges." Joining us now is Bloomberg's David Gura. David, this has been quite significant in a manner of ways for both the Teamsters and the unions having a representation at the RNC and now not endorsing either candidate. How big of an impact will this have on the race?
They have been trying to navigate this terrain where the campaign was really upended over a couple of months, and it's the biggest union in the country, 1.3 million members, and historically, in recent history, they have supported Democrats. Now they're not, so it is a big deal, and you heard President Trump, former President Trump, last night in this rally that he gave on Long Island, referring to support he's gotten from certain parts of the Teamsters local affiliates of the union. So I think it's disappointing for both candidates, but as you heard there from the general president, they were unable to kind of reach any consensus the likes of which they've had in past elections.
Well, I mean, is that surprising? Because we've heard so many policies being thrown out by these candidates, like a grab bag. I think Anne-Marie likes to call it an Oprah Winfrey moment of a car for you and a car for you. Yeah. And the fact that the Teamsters lead is saying that we've asked for certain things and we're not getting them.
Yeah, so it's, a right to form a union is, of course, paramount, and they haven't gotten the kind of commitments they want from both of these candidates, but you get back to that kind of Oprah moment, and I think it's such a good analogy. Last night, Donald Trump was floating again kind of new tax deductions, expanding the tax deduction for state and local taxes. He's very fond now of going to different places across the country, kind of assessing what people might want or need when it comes to tax policy in particular, and devising or divining what might be the way forward for him to get support by implementing them. There isn't behind that a lot of planning about sort of how to do that and how to pay for it, and just looking at the state and local tax deduction. It was something that he eliminated himself when he passed his Trump tax cuts the last time he was in office. And if you look at analysis of what it would cost to bring those back, we're talking about $1 trillion. So yes, there is this exuberance, this willingness to do it, excitement about doing it, but there isn't kind of the policy support behind it at this point or the clarity that one would need to do it.
Speaking of Trump, I mean, he's never shy from commenting on monetary policy. We got 50 basis points yesterday, something that he said it would be a mistake to Bloomberg if they did indeed cut. So we got it. What was his reaction, David?
Yeah, so he didn't bring it up explicitly in that speech last night, but he came through the city, came through New York City on the way to giving that speech and stopped at a Bitcoin bar downtown and did address it. And so he said it's a reflection of how bad the economy is. That's his one suggestion. Or that might indicate the fact that the Fed is playing politics. Of course, we heard from Fed Chair Jay Powell yesterday, this kind of very adamant, increasingly irritated response to that the Fed is fiercely independent and not doing that. I was, to be frank, a bit surprised we didn't hear more from him, knowing that it's something that he cares so much about, thinks that the Fed is kind of stacking things against him. But this was, of course, in this crucible, the last meeting that the Fed will have before the election. The next meeting takes place the day after the presidential election in November. So it's going to be seen through that political prism, even if it isn't addressed kind of as explicitly as I thought it might have been.
We also have next week the UN General Assembly happening here in New York. And of course, it's volatile times in geopolitics, which is probably an understatement. How could this also shape what we're seeing in the race?
So we have reporting that Vice President Harris is going to meet with President Zelensky when he is in the country, meet in Washington, D.C., and President Trump said it's probable that he's going to meet with him as well while they're both here. So it's an opportunity, I think, for both of these candidates to once again flex their foreign policy bona fides. And Vice President Harris has taken on some of that during the course of her time in the White House. She's gone to the Munich Security Conference, delivered some marquee foreign policy speeches. But you're right, having all of these world leaders in the U.S., in New York, but also spending time in Washington provides them each with opportunities to kind of meet with them, be seen with them, talk policy with them, and again establish that kind of fact they're able to kind of work with them on that international scale.
David, looking forward to your coverage of it.
Thanks
so much for joining this morning. That is Bloomberg Big Take podcast anchor David Gura. Now to the geopolitics. As we'd mentioned, Israel's defense minister declared what he called a new phase in the war with regional Islamist groups. Israeli troops are being diverted to the Lebanese border, raising fears of a wider conflict following 2 waves of exploding devices, which killed 32 people in Lebanon. For more, we're joined by Bloomberg's Jomana Bersecci. Jomana, what do we know about, again, what Israel has called a new phase of war?
Yeah, that's right. So we heard from the Israeli defense minister yesterday, Yoav Gallant, saying that the center of gravity is moving north and that they are mobilizing troops towards the northern border now. And this is a quote, "We are at the start of a new phase in the war, and we must adapt." And of course, you have to take that in parallel to comments from the Israeli Prime Minister Benjamin Netanyahu that he delivered on Tuesday, saying that there is a new objective, a new war objective, and that is to return security to the northern border. Yesterday, the Israeli Prime Minister gave a very short 10-second televised comment where he said, we said we would return the residents of the north safely to their homes, and that is exactly what we are going to do. And of course, this is the first time we have heard from the Israeli Prime Minister since those series of explosions have rocked the Lebanese capital and other cities around the country. Of course, Lebanon now is on a high state of alert after those multiple days, back-to-back days of communication devices being set off.
Jomana, we really appreciate you keeping us on top of this. Bloomberg Horizons Middle East and Africa anchor, Jomana Bersecci. Coming up, we're going to get to the big takeaways from the Fed's jumbo surprise cut. Surprise to some, at least to Marvin Lowe. We're going to catch up with him from State Street, the senior global macro strategist, and set you up for the rest of the week and next.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the S&P. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
A recalibration and a commitment not to fall behind the curve. That was Fed Chair Powell at the news conference after a 50 basis point cut. Joining us now on the phone is Marvin Lowe, senior global macro strategist at State Street. Marvin, can I just get your takeaway from both the decision and what we heard from Powell yesterday?
Yeah, for sure. I mean, I left somewhat confused because, ultimately understanding the Fed's financial transmission process really fell by the wayside. Recalibration with ultimately what seems like a moderate pace going into next year just don't line up. And I think if we think through how the Fed got to this 50 basis point cut where in a lot of ways they started the year thinking they were going to cut, then in the middle of the year they thought they weren't going to cut, and then all of a sudden out of the blue they think they're going to cut again. They really are data dependent, and that's going to create volatility in the market.
He said at one point, Marvin, let me just read to you his words. The time to support the labor market is when it is strong and not when you begin to see layoffs. He said this over and over. The labor market is strong and we are cutting by 50 basis points to support it. Should we view this, or at least do you view this, Marvin, as a real change in the way that they're managing risk?
I mean, for sure, the balance of risk has moved to the labor markets. You know, we saw that transition occurring over the summer and certainly went full force in Jackson Hole. Kind of having said that, we are still creating jobs. You know, granted, we are creating less jobs than we did earlier in the year. I think some of the revisions indicate that we were probably creating less jobs than we thought based on the initial expectation. But we're still creating jobs. And, you know, overall, the economy, when we look at it from, you know, current GDP estimates, is still above trend. So, you know, they are reacting. There is a risk that they're reacting a little bit too much. But, you know, for the moment, they think that they're in a solid place to start the normalization process.
Marvin, can you get into that more, the risk that they're reacting too much? What exactly is the risk there?
Well, the needle was quite small in terms of how they needed to thread it. So, you know, clearly Powell wanted to go 50. When we kind of look at the dots, it looked like there was probably half the committee that thought that they should go only 25, like kind of this moderate 25. But not only that, but by going 50 and the whole process around letting the market, if you will, to a certain degree, dictate that they got to 50 means that the market's going to continue to push for more. And I think that, you know, risk assets are supported from that. You know, the Fed put is still there, but they can push around 50. And if they wind up doing more than they think they need to because the market's getting them there, you know, we might actually loosen financial conditions when liquidity is still high and valuations are still quite high.
So Marvin, we're just about to the end of the show. So I just want to give you the last word on that point, on risk assets. Does yesterday's decision change anything for you on how you want to be allocated into this market? In just about a minute here.
Yeah, I still like risk. I think the Fed put is solid. I think the higher neutral rate and some of these discussions that are ongoing around the size of the deficit makes duration a little bit more challenging. But risk, credit, equities with the Fed put in an environment where the market could push the Fed around a little bit, should provide for a solid fourth quarter.
Marvin, thank you so much for joining us this morning. Marvin Lowe in Chicago, I should say, up very, very early for us in this post-Fed session. Marvin Lowe of State Street. You saw there stocks, risk assets so strong this morning. That is the notable trade of a Russell 2000 that is up nearly 3%. As to what's ahead, we're going to have a Bank of England decision. That comes in about 1 hour's time. Tomorrow it is the BOJ. In the meantime, this is the picture for you. NASDAQ 100 tech also really strong this morning, up some 2%. For bonds, it is a rally on the front end, and on the long end, less certainty. QT still happening. That unwind is still occurring. It is independent of the Fed's cuts, says Powell. 2-year yields, those are down nearly 3 basis points. Your 10-year yield is unchanged this morning. So a lot of the moves we had yesterday are reversing largely. The dollar also notable in this. The euro versus the dollar this morning, stronger by 0.5%. That is trading at 111. Sterling is also stronger by 0.5% as well this morning, ahead of that BOE decision, even though they are not expected to move. Asian currencies also incredibly stronger, the strongest in a basket since July of 2023. Surveillance, it's ahead.
First of all,
global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar, they're leaders in EVs, they're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries, and those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point.
This is not just a 50 basis point cut. This is the dovish 50 basis point cut.
How do you do 50 without scaring people that you know something bad about the economy? And I think he did that very well.
This was not signaling that we're ready to cut. This is a window of opportunity to cut now.
I think when you go forward, it is a soft landing baseline.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It's an equity market rally on delay. What's this about? From New York City this morning, good morning for our audience worldwide. Bloomberg surveillance starts right now with equity futures on the S&P 500 up by 1.5% on the S&P as Chairman Powell takes center stage.
Our patient approach over the past year has paid dividends. We now see the risks to achieving our employment and inflation goals as roughly in balance. We are not on any preset course. We will continue to make our decisions meeting by meeting. I do not think that anyone should look at this and say, oh, this is the new pace. So we know that it is time to recalibrate our policy, recalibrating policy, recalibration of our policy, recalibrating. We're recalibrating our policy. We made a good, strong start to this, and that's really, frankly, a sign of our confidence.
One word on repeat throughout that news conference for the best part of 60 minutes, recalibrate, recalibrate, recalibrate.
We've moved the debate to, will it be 25 or 52? Was it a dovish or was it a hawkish 50 basis points? This comes at a time where this is one of the most discussed Fed meetings ever. And RBC's Blake Gwynn put it perfectly, that the Fed's eventual decision to cut 50 basis points landed in markets with about the same splash as an Olympic diver.
Hawkish 50. How many times did we see that? Bank of America, hawkish 50. Capital Economics, hawkish 50. Kit Duke, SocGen this morning. There are disadvantages to putting a lawyer in charge of a central bank, but one advantage is the ability to make a 50 basis point cut sound like a hawkish move.
For what asset class? And this is what I thought was interesting. And yesterday, this is what the asset classes were kind of struggling with. Is it hawkish for stocks? Is it hawkish for the dollar? So it seems like it's hawkish for the dollar, but okay for stocks. And basically, this was a Fed chair that jawboned a market into complying with its view that this is an okay soft landing still, that they're not going to get away from, and that they're going to keep trying to be proactively ahead of in order to ensure that there is no deterioration.
We said this yesterday. Politicians in this country had drafts ready to publish as soon as this decision dropped, and that's exactly what we saw from Senator Warren. Senator Warren with her view, the former President Donald Trump with his own.
One thing is very clear. There is bipartisan support in Washington about using the Fed
basically as a support and going after them no matter what they were going to do. So Donald Trump came out, the former president, obviously the GOP candidate as well. I guess it shows the economy is very bad to cut it by that much, assuming they're not just playing politics. So the Republicans are basically saying if you're cutting by 50 basis points, you're either playing politics for this election or you know something we don't know. And then Senator Warren, who's been begging Chair Powell to cut the entire year, said it just goes to show an acknowledgement that Powell waited too long to reduce rates.
So if you followed this yesterday, the price action following this decision was a total snooze. On the S&P 500, we just about snapped a 7-day winning streak. This morning, we're off to the races. Equity futures up by 1.5% on the S&P 500. On the Russell, the small caps, Lisa, this morning up by 2.8%.
This is a Fed that wanted to confirm that there wasn't weakness at the same time that they're going to cut potentially aggressively, potentially by 100 basis points by the end of this year. I actually was surprised that the move didn't stick yesterday to the upside. I was reading through this and I didn't see anything that the Fed said that would undermine the idea that they had this market's back. And that seems to be the conclusion today as they project out an even steeper path of rate cuts. You can call this a hawkish cut, and you heard that from person after person, except for Mohamed El-Erian, who pointed to the fact that actually when you look at the statement of economic projections, this was a Fed where the median dot was 3.4% by the end of next year. That is below where the market was pricing in.
How likely is it that 50 is the first of many? This morning, the 2-year yield is down by 3 basis points. Your yield at the front end of the curve still in at around 360. Coming up this hour, we'll catch up with Peter Cheer of Academy Securities following the Fed's big rate cut. We'll speak to Norman Rule of CSIS on another round of explosions in the Middle East. And Jonathan Pingle of UBS looking for 25 basis point rate cuts over the rest of this year. We begin with our top story. Stocks rallying as traders digest the Fed's 50 basis point rate cut. Peter Cheer of Academy writing, all in all, think this is a close to a hawkish 50 we could get. Maybe close to neutral 50, but I give Powell credit for not turning too dovish during the press conference. If the Fed speakers in the coming days steer towards neutral, we can rally across the board. Pete joins us for more. Pete, good morning to you, sir.
Morning.
First impression, please, of the news conference yesterday.
So I think they were trying to be a hawkish 50, and I think the market's looking at the things. You had a dissent, that's hawkish. They definitely pulled back on the rate cuts coming into next year. I think we were priced into like 10 rate cuts by the end of last year. Now it's only down to 7. He didn't get too dovish during his press conference. On the other hand, weighing on the other side of the scale is they actually went 50 bips. People were talking about not going 50. Most economists had 25. So they can be as hawkish as they want. I think the market's going to lean towards this neutral. They actually did cut 50. So they said all this other stuff, but the reality was they did 50.
I was in the camp yesterday reading all the research on the way home. You were one of the first to publish, and I wrote down your quote. You said, for now, 50 basis points more this year seems like a certainty, and it is probably harder to only get 25 rather than 75. What's the balance of risk for markets into year end?
You know, I think we get now back to watching the data. I think yesterday one thing was very emblematic of that was I think we sold off a little bit because the hawkish interpretation was there, but also positioning it got ahead of itself. So now I think we're recovering a little bit. I think we can all hopefully stop talking much about the Fed and really getting where's the economy, what's going to happen with the election, what's going to be the outcome of the election on the economy. So that's kind of my hope is that the Fed's kind of on the steady course. We'll get 25 or 50. They're not going to drive the market that much higher themselves. They're certainly not going to be the thing that slows it down. Where do we stand on AI? Where do we stand in the economy? I do love that the small caps are starting to rally. They tried hard yesterday. They're coming back today. We need to see that stick, I think, for a few days. But I'm optimistic now that we might be near the end of this big rotation, or the old rotation starting a new one.
You can say whatever you want about some of the political ramifications after these decisions, that, you know, they're basically people trying to get attention, sound bites, et cetera. Senator Warren actually had a point when she said that maybe they made a mistake in not going in July, and this was basically a concession that they were too late. And his response to a question on that, if we had gotten the July jobs report before the meeting, would we have cut? We might well have. Is this just them playing catch up? And essentially, is that how the market's treating it?
Yeah, I think they certainly should have gone in July. That's part of the reason I think so many economists got stuck saying 25, because there was good evidence for them to go 25 in July. They didn't. I think the one thing, they do not know anything about the economy that we don't. I think that's myth's kind of been shattered, right? They should have known the jobs number at the time. There were so many obvious things pointing out to the weak jobs reports leading up to that. So I think this whole concept that the 50 has anything to do with the Fed knowing something worse than us, that's just non-existent, I think, at this point.
What are you looking for to understand whether the enthusiasm that you're seeing in small caps and some other sectors of the rate-sensitive markets are getting ahead of themselves, are getting frothy?
So I think we need to see how some of the data plays out. We need to see a couple more days of this, right? Like yesterday, although we ended up kind of unchanged, there was some pretty good volatility, right? We were up, down, all around. So I need to see this go through a few days where, okay, we've now stabilized. Let's see people move away from this Fed narrative to where's the economy, what do earnings look like? And I think that's going to be okay. I think we'll actually get some decent jobs data. I think we're going to see support for the economy. And I think that's what's going to have to drive this. I think hopefully we're in a brief period where okay news is actually good for the markets.
Okay, so you think that we should all move on from talking about the Fed, focus on other things, politics then. One of them, we're less than 50 days out from the U.S. election. What's your base case now?
You know, I think our base case, and I think this is probably where Wall Street's coming out as a whole, is gridlock. So it feels like, to me, there's going to be enough people voting against someone rather than for someone, and that often leads, I think, to splitting the ticket, right? If you're voting against someone, maybe you don't want that power party to be so much. It does look like Harris is in the lead, but on the Senate side of things, looks like Republicans will retain that. So I think gridlock and not much gets done.
So if there is gridlock, how do you want to basically effectuate that in the markets?
You know, I think yields go a little bit higher. I think at the long end, we saw that a little bit yesterday. We're seeing a little bit today with the 10-year kind of even, 30-year. I think we push back towards 4% on 10s, partly because I think there will be no fiscal, control in D.C. regardless. And it's not going to be massive because no one's going to get too much done, but we're going to get back to that path. I think the Fed did make it pretty clear that they're not in a huge rush to get to the 2.875%, right? That they didn't talk about that now till the end of 2026, and the market was pricing that for next year. So I think they're going to be slow on this. We're going to get these 25s, and we'll start getting more and more policy information. I think we have global friction going on. Right now, we're a little bit optimistic, though. Maybe you see some tensions ease. There's so much going on in Russia, Ukraine. Maybe there's room enough for that to de-escalate, and same with what's going on in the Middle East.
Let's just unpack that. Let's park the geopolitics for a moment. We'll come back to it. I want your thoughts on the bond market, just a little bit more detail. Are you saying the bond market's a sell regardless who wins in November? And does that matter? Does it matter when it comes to how divided Washington might be after the election?
Yeah, I think the bond market is a sell as we start going through this, right? We're going to start talking about, more debt ceiling talk, all that usual noise. People are going to get a bit nervous. And I think no matter who's in charge, we're going to see fiscal, spending. We're going to see spending. We're not going to see the income. So I look for yields to drift higher at the long end. I think the front end's very controlled by the Fed. I think the front end 2 years is kind of roughly decently priced. Maybe it drifts a little bit higher in yield. It's going to be at the 10 and 30 year that we lose a little bit of control.
Got it. This is the boring stuff. Now we can talk about exploding walkie-talkies. What is going on in the Middle East? What are the generals at your firm telling you? What on earth is going on in Lebanon?
I think this was a very clear statement that Israel is now redirecting away from Hamas. They're going to continue that battle, but now they're going after Hezbollah. And I think if you go back in time, right, Iran attacked Israel with 1,000 drones, missiles, and there was some discussion, well, maybe it was a fit, they weren't really trying hard. One belief was that they actually were trying. You don't send 1,000 projectiles at a country and hope that they all get shot down. So that may have been Iran's best effort. So this attack on Hezbollah is a reminder Iran, you've been impotent, right? For 2 months, we've been talking about another attack. So maybe this starts bringing everyone to the table, and Israel really flexed their muscle and said, not only do we have the power of traditional military, look what we just did. So maybe this is kind of that first stage towards a de-escalation, because deterrence is often the best policy. And I think now you've went out, I think if you're Iran and you don't have weapons to attack them, Hezbollah just got attacked viciously. Maybe you all say, let's take a break on this.
I was asking this yesterday. Is this escalation to escalate or escalation to de-escalate? And your generals are telling you this is a sign that potentially we could see de-escalation of what's going on right now in the region?
Yeah, and we talk about this all the time, and deterrence is such a difficult thing, right? Because deterrence, it really has to come down to not only do you have the weaponry, but you've got the willingness to use it. Now you just saw this, and I think we were talking off air, what else have they implanted? What else do they have out there that you don't know about if you're Hezbollah, Hamas, even Iran? So I think this was a real, smack, a real flex, and that's the sort of thing that I think can really cause the deterrence. And so it's an escalate to de-escalate, especially if we're right, and Iran really did try and use a lot of their weaponry with that first attack, gosh, how many months ago now with the 1,000. If they really don't have anything effective, maybe this is a good time for Iran to just say, too, let's, see what we can pause.
Is this the reason why markets haven't been paying attention to this?
Yeah, I think we've kind of hit the status quo where what we were all worried about, I think, was the flow of oil, right? And unfortunately, in the region, the biggest thing I think that's going to impact the U.S. is the flow of oil. Would the U.S. sanction Iranian oil? Would oil stop flowing due to Hezbollah? there really wasn't that much of a slowdown, and that continues to be the case. And I think, again, you're still in Russia and Ukraine. Same idea, right? There's all going on. There's some attacks in and around refineries, but really everyone's kind of been hands-off in terms of oil, and that's what's going to feed most directly through to the global economy, and that's why markets are not paying attention. I think that you get that initial fear that this could escalate into that, and it feels like everyone is playing the game of, yeah, we can fight each other, but let's keep oil okay.
Peter, you mentioned deterrence and how important your generals say that is. We're seeing this from, although they're not saying it out loud, but we're seeing this from the Israeli side. Do you think the United States has set any deterrence? Your generals, do they think that in the region?
You know, I think our presence there is important. I think we've backed off. I think some of the negative messaging towards Israel. Obviously, Blinken's still there trying to push for a peace, but it doesn't feel like every day we're admonishing Israel for their attacks. What's going on? One weird thing, I'll go kind of off script here, but one of our generals talks about the whole frustration with 2,000-pound bombs. Right? We didn't want to give Israel 2,000-pound bombs. And he's like, that was actually counterproductive because a 2,000-pound bomb is designed to go through the ground, into the tunnels, and explode below the surface. Most civilians are on the surface. If you don't give 2,000-pound bombs, you drop smaller bombs, but you have to drop them one on top of each other. So the first ones actually do more surface damage, which are where the civilians are rather than combatants. So we're kind of interfering with a lot of things when Israel is making real efforts. They actually have one of the lowest civilian casualty rates versus combatant casualty rates of any recorded, attacking. So they've been doing this job so I think we've kind of stepped back from telling them no every day. That's let them proceed. And I think that was a big step to helping them in the deterrence.
Pete, just before you go, do these gains stick? Is this the Europeans playing around? Does America wake up, the adults come into the room and sell this?
I'm a little bit worried about that. So I think we faded a little bit. What I'd like to see is a nice 1% close. I think if we get this 3 or 4% close, which could happen because everything now is so volatile, we've got the zero-day expiration options. I think you want to fade that. I think you're looking for something that settles in around 1%, and then you want to buy that market.
Bit of chair, thank you. Bit of chair of Academy. Lisa, equity futures up by 1.5% on the S&P.
Can you imagine if I said that?
I know, I just offended the whole of the city of London. I apologise.
When the adults come back in the room, is this just Europe playing around?
Don't you just think it feels a little bit odd that we did nothing yesterday in the afternoon when Europe was closed, and then we come in this morning and we're up 1.5% on the S&P and up almost 3 on the Russell?
Maybe they're the adults. Maybe they're looking at this and saying all roads end up with risk assets higher.
Maybe we're the children.
Maybe we're the children.
We'll find out.
All I know is Wall Street is sick of talking about the Fed and is seeking a chance to possibly move on.
And now we get to talk about your favourite thing, the election, just a little bit more. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Morning, Danny.
Good morning, John. The EU is warning Apple to open up its iPhone operating system. Sources say EU watchdogs are expected to announce that the company must step into line with strict new rules from its Digital Markets Act and make its operating system fully functional with other technologies. If Apple doesn't comply, the EU could launch a formal probe which could lead to hefty fines. People familiar say Ampere Computing is exploring a potential sale. The semiconductor startup backed by Oracle has been working with a financial advisor in recent months to help field takeover interest. It does suggest that Ampere doesn't see an easy path to an IPO. It had filed for one in 2022 and was valued at $8 billion. The U.S. is suing the owner and operator of the ship that hit the Francis Scott Key Bridge back in March. The DOJ is seeking more than $100 million to cover costs of the destroyed bridge and operations that were brought to a standstill at the Port of Baltimore. The civil lawsuit alleges that a, quote, ill-prepared crew on an objectively unseaworthy vessel was sent to navigate the U.S. waterways. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Donald Trump's tax-cutting spree.
I will cut taxes for families, small businesses, and workers, including restoring the SALT deduction, saving thousands of dollars for residents of New York, Pennsylvania, New Jersey, and other high-cost states.
I took it away, and now you can have it back. That conversation up next from New York. Good morning.
Party.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
You went to sleep last night, which snapped a 7-day winning streak on the S&P 500, and you wake up to this. Up by 1.6% on the S&P 500. Equities advancing here. Lisa, not a major move in the bond market, the 10-year at 370. Peter Chair of Academy, when he left the room just moments ago, he said, look at dollar yen. The fact that dollar yen was stable overnight in Asian trading may be the green light to buy risk here.
Maybe this isn't quite as negative as some people thought it would be, the sort of hawkish tilt. Although I have to say, the idea that you're seeing a strong dollar defies a lot of the risk asset move that we're seeing, because on one hand, is this a hawkish 50 basis point cut? Honestly, do we really want to have this conversation? I don't. I think that my head is going to spin.
When you figure it out,
yeah,
let us know.
Okay.
Dollar yen at about 143. Under surveillance this morning, Donald Trump's tax-cutting spree.
I will cut taxes for families, small businesses, and workers, including restoring the SALT deduction, saving thousands of dollars for residents of New York, Pennsylvania, New Jersey, and other high-cost states. I will deliver the greatest economy in the history of the world to our country, and one of the greatest economies in the history of New York State.
So here's the latest. Donald Trump looking to court New Yorkers with a pledge to restore the SALT deduction. It's the latest in a series of tax breaks Trump is pushing with less than 50 days to go until the election. Here in New York, Bloomberg's David Gura. David, good morning to you, sir.
Morning.
Okay, how expensive are these rallies getting for Donald Trump?
You know, it is a thing to behold, and a lot of magic is happening at them. He goes to Nevada and promises he's not going to tax tips. Here we had him talking about SALT. I mean, it's fascinating to watch somebody who did away with that unlimited deduction on SALT just a few years ago, now talking about this. But we know from independent analysis that if it were to be restored, we're talking about $1 trillion worth of cost. So, yes, he's very good at kind of tailoring and catering to these audiences. He was on Long Island last night, but he's not going to be meeting that with policy, or as you say, meeting with how they're going to pay for it if in fact they were to be implemented once again.
Do we expect Kamala Harris to come out and start talking a lot more about SALT? It's something we know that senators, Democratic senators from these high tax states talk about, like Schumer, but will Harris start talking about SALT?
That's a great question. I don't know. I mean, I'm waiting to see sort of how she responds to this, of course, but of course, it is really important. I mean, what was struck me last night was listening to Donald Trump talk about how he thinks that New York is winnable, and I'll buy everybody here a drink if, in fact, the Republicans take New York as a whole. But I think what we saw last night is kind of a not-so-shameless attempt here to bolster the candidacy of 3 or 4 Republicans who are in Congress, hoping that they can hold on to their seats. And he might talk about kind of something all the way down ballot to the top. Doubt that happens, but again, I think very a shrewd, as he sees it, a shrewd political move on his part.
Yeah, absolutely. They're trying to shore up basically those seats in Long Island that put Republicans over the edge. He also talked about this yesterday, similar in the economy. He says that as president, he would immediately implement a temporary 10% cap on credit card interest rates, saying we can't let them go to 25% and 30%. Is he starting to sound a little bit more like Senator Bernie Sanders, who actually was asking for a 15% cap, even higher than what Trump is now talking about?
I think we're seeing this kind of new reinvention of populism that he espoused in part the last time that he was running. You know, the strange thing about all of this is what he would be able to do or not be able to do if he's elected. And you were talking with Peter just a few moments ago about the gridlock that we would expect in Washington after this election. You know, for any of these proposals to become law, he'd need the support of Congress. Seems entirely unlikely that he's going to have an easy way of doing that should he be reelected.
Well, that's not necessarily true, though, with the SALT tax deductions. Because if you think about the SALT cap, you have a number of Democratic senators, as Anne-Marie was just mentioning, who are very much for reducing the cap on the state and local tax deductions. You have a number of Republicans, particularly from New York and others, who would pass it. Why wouldn't this be feasible?
Sure, it could be feasible. I think what we're seeing, though, is this kind of inchoate catch-as-catch-can making of tax policy on the campaign trail. Again, I think that it's more grounded in populism than actual policy, and I think the debate du jour is how much policy do these candidates really need to put onto paper and give to constituents? Like, how much do they actually really care about this? You're right. I think that there is, if not broad support, there is bipartisan support for some of these changes. We'll see what happens here. I'm skeptical that 47 days out from the election, we're going to get more detail going into it, but we'll see if that happens.
Let's talk about the policy that matters. Who actually endorses these candidates? Because that seems to be what a lot of this is catering toward. And we're wondering about Donald Trump, but with Kamala Harris, she didn't get the endorsement of the Teamsters for the first time in a very long time. In fact, they had previously endorsed Joe Biden, and since he has withdrawn from the race, there is a great deal of support for Donald Trump within the ranks. What do you make of that? How much does that dent her potential support?
You know, it's interesting. The Teamsters did support a Republican back in 1988, but it's been Democrats ever since then. And we've seen kind of a recalibration, as we've all been kind of recalibrating since this campaign was upended a couple of months ago. I think it is a big deal for her. There's 1.3 million people in the U.S. who are strong, ardent union members, and she would have loved to have them. And we saw her campaign noting that there are kind of branches of this union that did throw their support behind her. The general president did encourage these local branches to do that. Likewise, some of them did that for Donald Trump as well, and he falsely claimed last night he did have the support of the Teamsters during the course of that speech. Look, she wants to be seen as the candidate for labor. It was an easier sell for President Biden to make that case. He has an easier way with unions than she does. Yeah, it is, I would say, at very least notable the fact that this giant union didn't throw its support behind a candidate, and certainly Kamala Harris wanted their support.
But Dave, do you think it was a crisis of their own making? I mean, I was there when Sean O'Brien was at the RNC giving this speech. He got an absolute snub to attend the DNC and give a speech.
Yes, I do think it was a crisis of their own making. And again, I think it shows this kind of unease or lack of ease that Vice President Harris has with unions that President Biden did have. And I think that it's a misstep on their part. Will it make a difference? Who knows? I think, of course, there are other unions who have supported her from all branches of work in this country. But yes, I think that it was a clumsy thing on the Democrats' part.
If he wins New York, I think we want more than a drink, right?
100%.
We're renting out 11 Madison Park and forcing them to bring back beef. It's a very New York joke.
You're not a fan of the vegan menu?
It's a very New York joke, by the way. You had that stuff?
I have not, no.
You're not a fan.
All I can say, and you're footing the bill, because you just offered it.
Okay, yes. Well, I'll try that. The vegan, do they like...
No.
You've eaten there?
I meant it. We're forcing them to bring back meat.
Okay.
The
David,
chicken was very good.
We can make that work soon.
No mas.
Right, sorry.
David Gurr, thank you, of Bloomberg. Our very own. Coming up on the programme, first they came for the pagers, and then they came for the walkie-talkies. Up next, on a series of mystery explosions across Lebanon, Norman Rule, a former senior U.S. intelligence official, joins us on the other side. Your equity market on the S&P 500 advancing this morning by more than 1 full percentage point on the S&P 500 and a whole lot more on the Russell. The rally resumes from New York. This is Bloomberg.
Because I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Check out these gains. On the S&P 500 up by 1.6%, on the Nasdaq up by 2 full percentage points. On the Russell yesterday, we just about squeezed out a sixth day of gains on the Russell, the small caps in yesterday's session. And then this morning, pop, up by almost 3% on the session.
Basically, this was Jay Powell came out and confirmed that there was strength in the economy and that he was cutting by 50 basis points. A real question as people parse through, was it a hawkish 50 basis point rate cut? Either way, what this means is risk assets are flying. You've got the dollar somehow stronger, and you have basically just some nullins in the bond markets. Is this mission accomplished for at least, market response?
I'm pleased you mentioned the bond market, because if you compare what's happening in equities to what isn't happening in the bond market, the compare and contrast is pretty stark. The bond market, really, really muted price action yesterday and again this morning. We've got a two-year yield down by 3 basis points. I think Andy Schneider over at BNP Paribas did a decent job of summing things up with this quote. We view the Fed's decision to start the easing cycle with a 50 as more about making up for holding steady in July, rather than a signal of a similar jumbo-sized move at any time in the near future. Lisa, echoing what you said about 30 minutes ago.
Well, and this is basically what Jay Powell said himself. You talked about Kit Jukes in his comment earlier this morning. I really loved it. It was just fantastic. The headline something like, "This is why it's good to have a lawyer as a central banker." But there are disadvantages to putting a lawyer in charge of a central bank, he wrote. But one advantage is the ability to make a 50 basis point cut sound like a hawkish move or anything else that you want it, basically catering a little bit to everyone at a time where ultimately there was almost a concession by Jay Powell that this was basically catch up from July when they should have cut rates.
So what is going on? One theory, Peter Chair of Academy was in the room about 15 minutes ago, and as he headed to the exit in the studio, he said, look at dollar yen, so let's look at dollar yen. He said that maybe people were waiting to see how dollar yen took things overnight in Asian trading, and if you got some stability and you didn't get the yen ripping, then maybe risk can start to make a run. Dollar yen's at 143. We've got a stronger US dollar against the Japanese yen on the session.
It basically argues for the hawkish 50 basis point cut. Hear me out. This is the reason why. If you believe that this was a Fed where they'd already eased much more significantly than the market was expecting, you would expect that divergence to widen between the Japanese yen and the dollar. If the Bank of Japan were to hike on Friday, they're not expected to, but if they were, that would only widen the gap that much further at a time where you are seeing other central banks move away from the Fed. The fact that's not happening signals that people don't believe that this is anything like a dovish 50 basis point cut and underscores the strength that a lot of people are betting on.
Two more rate decisions still to come. The Bank of England later on this morning. We'll get to that a little bit later. And then you've got the BOJ, as Lisa pointed out, to kick things off on Friday going into the weekend. Under surveillance this morning, the International Brotherhood of Teamsters declining to endorse a presidential candidate for the first time in nearly 3 decades. The Teamsters General President saying, quote, neither major candidate was able to make serious commitments to our union.
So unofficially, they're not coming out with this endorsement, but you can see both camps are trying to spin the snub, most notably Donald Trump. He came out and said it's a great honor. They're not going to endorse the Democrats. They're not lining up where most unions are. But I would look under the surface. Trump is saying this because when you look at the surveys done internally by the Teamsters, majority say they support the former president. So what really stands out to me is that this is a union that endorsed Joe Biden in 2020. Kamala Harris, as to David's point, has a lot of work to do to go down to the rank and file and meet these individuals on issues they care about.
No one's listening, right? So basically, the way that I gauge a lot of these stories, I start to think, okay, how do I put this into perspective to see whether it matters? And I go to predictit.org and I see if anything has changed in terms of the odds of which candidate has a better chance of winning. And it has remained unchanged, basically, virtually, for the past week or two. Basically, I'm like, ignore. I mean, isn't that essentially what people are doing?
Yes, but it's tea leaves into where the work needs to be done and in which states. So, you know, New York Times this morning comes out and has Harris up in Pennsylvania. Marist, meanwhile, has Harris and Trump tied in Pennsylvania. The margins are so slim. So to understand potentially where each candidate is able to make any inroad is really important, because this race will be won and lost by a few 10,000 votes in a few states.
This is still a really tight race, that's for sure, across all the swing states. I want to turn to this story. Stunning numbers out of Germany. Really, really bad numbers out of Germany. Stunningly bad numbers out of Germany. I don't think you can overstate this. Look at the numbers coming out of the EV sales. So we just had the European Automobile Manufacturers Association numbers finding deliveries fell 69% during August, leading to a 36% drop across the whole of the region. So the group's urging the European Commission to take urgent relief measures, and this coming at a time when we heard from the German company Volkswagen in the last couple of weekends suggesting that they might close plants in the country for the first time in its 87-year history. Shocking.
Europe has a problem because this is their major economy. This is the biggest economy in the European region, and it's a structural problem. If you want to know why the dollar isn't weakening even more on the fact that they cut by 50 basis points, take a look over at the German manufacturing sector, because ultimately that is the reason why it isn't necessarily the alternative.
Stunning but not shocking. The chairman of VW said the other day, electric mobility is the future of individual mobility, but, and I can't emphasize this enough, politicians have given the industry targets without the necessary infrastructure to get there, and also the people willing to get there and wanting to line up to buy these cars.
One of two things needs to happen in the next 12 months. Either you're going to see a massive cut to jobs and capacity in the European automobile industry, or the politicians have to get their act together and you're going to see a big relief package. One or two things has got to happen. I don't see how this continues. It's not viable.
You have to either have massive subsidies that subsidize almost a similar production kind of program as what's going on in China, which is overcapacity, because that's essentially some of the targets that they've been putting into place. But you have to imagine that that comes with ratcheting up tensions with China, which is currently a big buyer of a lot of German automakers' products. So it's a really difficult moment, and you hear that when you talk to the CEOs of a lot of these automakers.
That's the latest out of Europe. Here's the latest out of the Middle East. Walkie-talkies exploding in Lebanon. A day after pages exploded across the country. Lebanon blaming Israel for the blast. The Israeli defense minister calling this a new phase in the war, with regional Islamist groups saying troops will be diverted to the Lebanese border. Leading our coverage out of the region is Bloomberg's Jumana Basechi. Jumana, you know this country better than most in our organization. How tense are things on the ground in Lebanon right now?
Very tense, very tense. I mean, this is the second day that you've seen these telecommunication devices used by Hezbollah explode all simultaneously. Yesterday's catalyst were these walkie-talkies used by Hezbollah group members exploding simultaneously, once again, similar to the pager explosions that we had the day before. The health ministry putting the number now of casualties at 450 from yesterday's explosion, 12 deaths, and that is in addition to the deaths from the day before as well, 2,800 people injured on Tuesday. And so the country is in a high state of alert. There is a lot of concern about what this all means, not least because, number one, the telecommunications system has been compromised. This is the biggest security breach that Hezbollah, they themselves, admittedly have ever seen. And number two, because there is suspicion that this could be a precursor to a larger military operation from Israel into the country. Now, Israel have not commented directly on the incidents, but we did get a very short televised comment from the Israeli Prime Minister Benjamin Netanyahu yesterday saying, "I said we would return the residents of the north safely to their homes, and that is exactly what we will do." And in addition to that, we also had comments from the Israeli Defense Minister Yoav Gallant saying that this is a new phase of the war. The center of gravity has shifted to the north, and that they're going to start deploying troops in the north. So yes, we have entered into a new phase.
Jumana, what are we hearing from Hassan Nasrallah?
So Hassan Nasrallah is set to be giving a speech later this afternoon at 5 p.m. So we will be hearing from the man himself. This is the first time he will be speaking publicly. He typically gives these televised addresses. One thing I do want to note, actually, is the explosives that went off yesterday, the walkie-talkie explosions. Some of them actually detonated during the funerals of some of the people who had fallen victim to the pagers exploding the day before. And so really striking right at the heart of Hezbollah territory. And of course, they are on the defensive here, and they have instructed all of their operatives to cease using any of their mobile phones. Even other countries around the Middle East, you're hearing the likes of Syria, Iran, also getting very concerned about the state of their own telecommunications. But I would also say that one thing to bear in mind is that the Iranian ambassador was injured on the first day of these explosions. And we also had comments from the Iranian envoy to the United Nations. They sent a letter saying that Iran reserves its rights under international law to take required measures deemed necessary to respond to such a crime. So this isn't just a Lebanon situation. It could potentially be a broader regional problem as well.
A crazy couple of days. Appreciate the update. Jumana Basechi, thank you. Norman Rule, a former senior U.S. intelligence official, joins us now for more. Norman, I want to take a question that Anne-Marie asked at the start of this program. Is this an escalation that leads to escalation, or an escalatory step that leads to de-escalation? Which one do you think it is?
Good morning. It will depend entirely upon Hezbollah's decision-making. Israel's goals are simple: cease the attacks, return its people to the north. It's not looking to enter Lebanon. The problem is that Hezbollah itself has suffered such a catastrophic blow that its own decision-making is likely going to be complicated and slow, but the next few days will play that out. I do expect some symbolic Hezbollah counterattacks, but again, Hezbollah's got to decide where it wants to go, and the U.S. diplomacy will be looking to exploit this dramatic moment to see if you can convince Hezbollah to indeed withdraw.
Norm, what do you think? What do you make of Peter Scheer's idea that he was talking about, where the salvo that Iran launched at Israel was actually all that it had, the thousands of missiles, and that essentially Israel is calling their bluff with this attack and others by saying we can provoke you because you don't have anything left in the arsenal? Do you believe that's actually the case?
No. Iran fired hundreds of rockets, missiles and drones, but it retains a large missile program. In fact, it's the largest in the Middle East, much larger than Israel. In fact, most other countries combined. It has the capability to launch further missile strikes against Israel. The challenge is it would have to get through the defensive ring that the U.S. has provided with its aircraft carrier task force.
Do you have a sense of what else could be potentially in the pipeline from Israel toward either Hezbollah or some of the other Iranian proxies? This definitely has been obviously on the minds of many of the leadership, but is there any sense that we have of whether this is the opening salvo for Israel or whether this has essentially been a plan in the making for a long time that has been launched?
Well, there is no question that Israel's political leadership is under significant pressure to return its population to the north. They have participated in 11 months of diplomacy, and 60 to 80,000 of its people are not able to return to their homes. They have moved elements of the experienced 98th Infantry Division from Gaza to the northern border. There they have joined the very experienced 36th Infantry Division, which has been training for Lebanese war for some time, for many years, and they're prepared to launch actions. I don't think Israel is looking for a long-term ground war because of the cost to its economy, but we could see airstrikes, cyber attacks, special forces operations, and other operations such as we've seen with the explosive telecommunications devices.
Norman, someone in the intelligence world quipped to me this week that bad things happen when you buy predictability and when you buy it in bulk. What else may be predictable that the Israelis can infiltrate?
Well, anything in a supply chain is vulnerable to manipulation. And this is an old technique. As far back as the American Civil War, coal was used as to mask explosives successfully by the Confederates. And during the Second World War, the Nazis attempted to infiltrate an explosive Peter's chocolate bar to reach Winston Churchill, perhaps a variation on the phrase bangers and mash from the menu option. So really anything that's in a supply chain that's close to Hezbollah leadership or operatives is something that will be open to interdiction and manipulation and lethality.
Norm, we hear a lot from this administration that they don't want to see an expansion of this conflict. So I have a two-part question. Do you consider this already a war? And given the fact that there is U.S. military personnel in this region, do you disagree with what Kamala Harris on the debate stage was that there's no U.S. soldiers fighting in active war zones anywhere in the world?
Well, first, Israel has endured thousands of rockets from Lebanon and Lebanese Hezbollah. That's a war-like situation. They have conducted airstrikes in a number of military operations against Lebanon. I mean, maybe there isn't a declaration of war, but this is a war-like environment. And for U.S. personnel in Syria, Iraq, the naval personnel who have been on the receiving side of hundreds of Houthi missiles and drones. This is certainly a hostile environment, again, without a declaration of war, but it's a war environment, and they should be entitled to combat badges as a result of their service. Therefore, I do think the Vice President, at the very least, misspoke.
Norman, your insight's valuable, as always. Thank you, sir. Norman Rule there of CSIS. A lot of interest in this story. Any more details, we'll bring them to you, of course, over the next several days. Let's give you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden will speak later today at the Economic Club of Washington about the state of the economy. He's expected to celebrate the FOMC's outsized move, calling it a validation of his economic policies and the beginning of a policy shift bolstering the labor market. White House Chief of Staff Jeff Zients telling reporters, quote, "This is not meant to be a declaration of victory. It's meant to be a declaration of progress." Kamala Harris plans to meet with Volodymyr Zelensky next week. The Ukrainian president will be in Washington. Sources say he's expected to push his country's bid to join NATO and the EU. He's also expected to ask for a continued supply of more advanced weapons. Zelensky will present his plan to President Biden on the sidelines of the UN General Assembly later this month. Coco Gauff is looking for a new head coach. The 20-year-old tennis star has officially cut ties with Brad Gilbert after only 10 months of working with him. Gauff had a disappointing run at this year's U.S. Open, where she was knocked out in the fourth round by Emma Navarro, ending her run to defend her 2023 title. Gilbert shared the news on social media and wished Gauff well in the future. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Bank of England decision is about 15 minutes away. Here's a take for you. And on Twitter, X, whatever you want to call it these days, Blue Horseshoe Loves. This is the handle. Here's the take. What's the narrative today with equities at all-time highs? Bank of England rate hike, bullish. Rate cut, bullish. Governor Bailey shuffles papers, bullish. That's what it feels like this morning, right?
Well, basically, people are trying to find a narrative, and then they fit the narrative into whatever the events are that transpire.
That decision about 15 minutes away. Up next on the program, the cut heard around the world.
We're moving at the pace that we think is appropriate. You can take this as a sign of our commitment not to get behind.
More on that big decision. Up next, this is Bloomberg.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest, and whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Stocks up on the S&P 500 and the small caps too. And the Nasdaq, everything rallying, up by 1.6% on the S&P 500. Under surveillance this morning, the cut heard around the world.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. We're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate. You can take this as a sign of our commitment not to get behind.
So here's the latest. Fed Chair Jay Powell announcing an outsized half-point rate cut and doing so without panicking global markets. FOMC officials remaining split on the outlook for additional cuts through the end of this year. Jonathan Pingle of UBS writing, the 50 basis point rate cut largely met market expectations and exceeded ours. We also expect Chair Powell to lean into rate cuts to come, but stop short of saying another 50 is on the way. Jonathan joins us now for more. Jonathan, it's good to see you.
Thanks for having me.
So frame this for you. Is this, for us rather, is this catch up with what didn't happen in July, or does this set the tone for the cycle in the months ahead?
So I think both, right? I mean, it clearly was catch up. I would actually say, you could say it's catch up from June, right? I mean, right after the June meeting, they sent the monetary policy report to Congress. All but one of their own policy rules said rates should have been lower after that decision. So, this is catch up. It's coming to terms with the fact that monetary policy is restrictive, the sort of throwing the high R-star narrative out the window. But I think the other takeaway is that the bar for moving rates lower is not that high. I mean, if they saw a 114,000 increase in non-farm payroll employment and really felt like that was the signal to become a little bit more urgent in getting out of restrictiveness, I think that frames the risks going forward.
Let's talk about that word signal and where to look for signal in the weeks to come and where not to look for signal in the weeks to come. We said this met market expectations. It largely did. The market was leaning towards 50 more than it was leaning towards 25. Overwhelmingly, economists on Wall Street were looking for 25 and not 50. We talked about that repeatedly yesterday. Something didn't happen here. We had a speech from John Williams of the New York Fed. No conversation about 50. We had a speech from Governor Waller into the quiet period. No lean into 50 whatsoever. We had a couple of news articles in the media that teed up 50 again, and that's what got market pricing to where it was. Now, I'm wondering now whether I just ignore all the Fed speeches and listen to the 13th individual on the FOMC, which is just the media reports in the quiet period. What are you going to follow now? As a professional economist, what will you look for?
Well, I think the message is clear, and unfortunately for you all, it was print media instead of the television. But yeah, I mean, like, as
unnamed source don't work on TV.
Yeah,
you can't sort of like blank out, blur out the face, and muffle the voice. But carry on.
No, but as a professional economist and someone who was at the Fed and actually, I mean, overlap with John Williams in the system, right? I went into the Friday of the employment report thinking, and we were writing, like, okay, should we change the call to 50? Well, let's see what the employment report says, and let's see what guidance we get from Williams and Waller. They were the last speakers before the quiet period. Typically, that has been a time when the FOMC has rolled out some speakers to frame the decision. And to me, they clearly sounded like we were headed for a 25 basis point rate hike. And then all of the data since then essentially surprised to the upside, right? I mean, there was no shocker that should have undone that in the economic data in between those remarks and the meeting. making the news reports that repriced market expectations seemingly very important.
Jonathan, you've been at the Fed. How unusual is it to have a Fed chair who seemingly has this kind of clutch over the decision and the decision making? Because ultimately, that would be the implication here from some of the news reports and how it rolled out.
Yeah, no, that's a great point. I mean, if I went back to the Greenspan days, Chairman Greenspan, if you watched him at the board table, there was a reason he could control the board. I mean, he won the arguments at the table. He had vast knowledge of the data, et cetera. Chair Powell seems to be using a little bit more a combination of suasion, political skill, and armed with the staff research to help him, sort of make the case. But I think in this case, there actually looked like there was a fair amount of division over the decision. And maybe Chair Powell wasn't really, he was getting his way, but just barely maybe.
Also armed maybe with the tool to manipulate the market, right? I mean, is that basically part of it too? If the market is saying 50, it's easier to then jawbone everybody else into that view.
Oh, sure, right. I mean, that came up in the press conference yesterday, right? I mean, if the market had not been pricing the 50 basis point rate cut, would they have opened the market opened the door, they walked through? That probably did play a role, but this very easily could be, I mean, I don't want to, this could be what's happening behind the scenes. I don't know for sure.
It's getting politicized already, obviously, given it's an election year. But this rate cut, we know what it's doing to markets. When will it actually impact the real economy?
Well, I mean, this rate cut may or may not impact the real economy. The market's largely, I mean, if you look at the forwards, the market was largely anticipating a series of cuts, and the 2-year yield really hasn't moved a whole lot. And you were talking about the dollar earlier, right? If you thought about, the 2 years actually up over the last 2 days, which is something that's going to influence things like, dollar pricing. And the long ends come in a little bit, but, that is sort of where, we would look for sort of the instant reaction in housing, et cetera. And I think a lot of this was already priced, and you're already starting to see it a little bit.
Bingo, housing. Let's talk about it. The price is going up or down? Feels like we've just unlocked the market overnight in the last few days. Looking at the mortgage applications numbers, boom. What's happening?
Well, you're getting a pullback in mortgage rates. I mean, I think it's going to continue to support residential investments, single family. I mean, I don't know. There are affordability issues. There's a lot of heterogeneity in this market, whether it's the existing home sales, new home sales market, et cetera. But I think it's difficult to argue that lower mortgage rates are not going to support the housing market.
We talk about cash on the sidelines. I'm going to talk about people on the sidelines. For the last 2 years.
He's talking about us.
Yes. Waiting to get into this housing market, waiting for some inventory to really be unlocked with the people sitting on mortgages with rates far too low who should never have got them. But anyway, here we are.
Whoa, shots fired.
I'm just being really bitter.
I'm being really well in terms of their trade.
Perfectly.
Except that, the flip side is maybe they got in at too high of a price valuation because the levels are still high, which is your point. But I don't think, okay, you know what? Some people just lucked out.
You timed the market perfectly.
Yeah.
But I think it raises an important question. Are prices going up or down as we unlock a lot of inventory in this country off the back of a few rate cuts and a big rally in the bond market?
It's a huge debate because ultimately it's sort of a pace of supply and demand coming onto the market. And then it's affordability question because if you have a 6% mortgage, it's very different than having a 3% mortgage in terms of your, just monthly payment, 2 point something. It just changes the calculus a little bit in terms of what you can afford.
I've said the 3 handle on your mortgage is like the new Lamborghini on the drive.
I'm showing it off.
It really is.
We're not there yet, though.
Jonathan, we've got to leave it there. Good to see you, mate. Jonathan Pingle of UBS. Up next, a Bank of England rate decision just around the corner from New York. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big. 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point.
This is not just a 50 basis point cut. This is a dovish 50 basis point cut.
How do you do 50 without scaring people that you know something bad about the economy? And I think he did that very well.
This was not signaling that we're ready to cut. This is a window of opportunity to cut now.
I think when you go forward, it is a soft landing baseline.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your lineup looks like this. Coming up, Sri Governor of Aberdeen on a Bank of England rate decision. Henrietta Trey's of Vader Partners as Donald Trump and Kamala Harris pitch further tax cuts. And we'll speak to the Transportation Secretary, Pete Buttigieg, on a new merger in the airline space. Before we get to all of that, we need to talk about a Bank of England rate decision. Bramo, rates unchanged.
Yeah, which is really interesting at a time where they're also downgrading their growth expectation, maintaining the interest rate at 5%. That was the estimate going into this. Bank of England's Andrew Bailey saying we should be able to cut rates gradually over time. It was 8-1 vote, so that dissent, although not that notable for the Bank of England, it is normal. Talking about cutting gilt purchase stock by £100 billion over the next 12 months. But this is really what I thought was interesting, that they see the third quarter growth of 0.3% down from 0.4% in August. This just highlights how the Bank of England is not the Federal Reserve, that they're downgrading growth forecasts while keeping rates unchanged because they don't have the privilege, as they've learned over time with Liz Truss, of acting recklessly in any capacity.
And they don't have the confidence in the inflation story. The pound's a little bit stronger off the back of this. Cable at 132.92, just short of 133. We're positive here by 0.6%. Rates unchanged. The vote 8-1. With the details, Lizzie Burden joined us from the City of London. Lizzie, what's your take? Largely in line with expectations?
Absolutely, John. A cautious hold, exactly what we expected, except on the vote split, but we can get to that. The reason is, look, we had this services inflation spike yesterday, and we did think about maybe the impact of the Fed transferring across the pond. But look, the Bank of England wants to show that it has its own mind. And to be fair, Powell's kind of done a bit of the work for Andrew Bailey yesterday. There is also the big question of the budget on October the 30th. How much will there be fiscal tightening from the new Chancellor, Rachel Reeves? How much will that slow down the economy? Perhaps the Bank of England wants to wait until November to see that factor in. But just in terms of that vote split, Swati Dhingra, we know, has been the big dove on the committee. We were looking at how Alan Taylor would vote, the new member of the Monetary Policy Committee. As expected, he's gone with the majority. So an 8-1 split, as you said. The guidance, no press conference this time, no forecasts, but they do downgrade on growth. This is a bit like the ECB, for example. But we weren't expecting major changes here, and it is that cautious note that Bailey sounded at Jackson Hole, John. He says it's important not to cut too fast or by too much. So the expectation heading into this was that you would have cuts in November and December, 4 or 5 cuts next year. It'd be interesting to see how the pricing reacts. And just finally, QT held at £100 billion a year, the same pace as before, and a unanimous decision there.
Lizzie, help us understand the differences between either side of the Atlantic. What isn't happening in the UK, what has happened in America. We just saw a 50 basis point rate cut at the Federal Reserve. We're holding rates steady at 5% at the Bank of England. Why is the story so different between America and what's taking place in the UK and across Europe?
Well, look at where inflation is in the UK, 2.2% holding there. Yes, there's that worry about services inflation. And then look at the growth picture. Question marks, as I say, around what the budget is going to do. We've got the first Labour government in over a decade. And so we have those questions on growth as well. Hence the caution from Andrew Bailey, but wanting to prove that he is his own man. Of course, Jay Powell really coming out and saying that they are going to have that soft landing. So that confidence perhaps transmitting somewhat to the UK story.
Andrew Bailey may be trying to say he's his own man. It also highlights, though, how unique the Federal Reserve is in terms of their privilege to ease at a time where there isn't necessarily obvious weakness that they can point to. The fact that they downgraded growth in the third quarter at the same time that they lowered their expectation for inflation by year end, at the same time that they're holding rates steady, really highlights that. Lizzie, how much do you think that this is going to become an increasing burden on them, especially given the political considerations and political independence?
Well, remember that growth is the #1 priority of this government. So it is bad news for Keir Starmer that growth has been downgraded. As we look ahead to that budget, let me say, on October the 30th, there is this tension between the idea, and it's not confirmed, we won't know until we get there, but that it could be an austerity budget. How is that going to grow the UK economy? So in the past 4 months, we've seen out of 3 of them, no growth in the UK. This is not a good look politically, but it hasn't worried them, the BOE, yet enough to go for this cut today.
Lizzie, fantastic coverage, as always. Lizzie Burden there of Bloomberg, outside the Bank of England in the City of London. The pound, cable, the pound against the US dollar, just took out 133, the highest, the strongest we've seen the pound against the US dollar, at least going back to March 2022.
Can you imagine, you said this about the ECB, can you imagine if Jay Powell had come out and done exactly this? How much the market would have absolutely flipped out if they had held rates where they were because inflation was above their target, and not even that much above their target, putting aside services in the latest read in the UK. Honestly, to me, the fact that they're highlighting the political scene, or that Lizzie Burden was highlighting that, shows how different the conversation is in a country that suffered through the Liz Truss moment than it is in the United States.
This self-imposed debt break that seems to be taking control of the UK story on the fiscal side, a month away, there is one similarity. The political uncertainty, the fiscal uncertainty on both sides of the Atlantic right now. If you're a monetary policy official trying to set monetary policy for 2025 and beyond, the medium-term outlook, whatever that might be, how much things could change in the next few months for both central banks?
Especially at a time where we're talking about potential tariffs, et cetera, in the United States. What the reaction function, though, is of a central bank is interesting. In England, maybe the incredible emphasis is on protecting the pound after what happened with Liz Truss. In the United States, is it the same calculus? Or is it save the economy at all costs, protect the labor market, maybe depending on the incumbent, but also just in general, is that also just the general feeling at the U.S. Central Bank?
Rates unchanged on Threadneedle Street at the Bank of England. Rates unchanged at 5%, in line with expectations. Joining us now to discuss is Sri Kochagambadhan, Senior Research Economist over at Aberdeen. Sri, we'd love your first reaction to this decision this morning. What do you make of it?
Well, I think this is very much in line with what the markets had expected, actually. So nobody was expecting a cut today, and nobody was expecting really anything other than 100 billion in terms of QT, that pace. We'd already had the markets participants survey, the MAP survey was out, and that was quite unanimous in terms of the pace of QT going forward, and also in line with what the Bank of England had already suggested in terms of a very gradual pace that is predictable as well. Gradual and predictable. I think those are two key messages there. But I think it's quite interesting comparing across central banks. The Bank of England actually has a slightly different position in that, A, it doesn't have a dual mandate, which the Fed has. That's one thing. The Fed does have a different framework. The second thing would be that growth in the first half of this year has been quite resilient in the UK. And yes, it is slowing. The projections are slowing. I think the projections across the street, our projection also is for growth to slow over the course of the second half of the year, but it is nonetheless relatively resilient compared to Europe, at least. It's in a very good position at the moment. So there's no need to panic in terms of the pace of easing. And we can look at perhaps the next cut that we're expecting is in November, and then a very much slower pace than the Fed or the ECB, so a quarterly pace from there on is probably the most likely outcome for the Bank of England, but very much in line with where inflation is and a slightly more resilient growth picture as well for now.
Sri, have we ever seen such a divergence between banks that have the dual mandate and those that don't?
I'm trying to think actually in terms of the history here, but I think the UK has definitely been less influenced by the Fed, and I wasn't expecting the Fed to influence the Bank of England this week. However, I do think that the Bank of Japan will be watching the Fed closely, but also, more importantly, the market reaction to the 50 basis point cuts. So I think there's some interesting divergences, more so for the Bank of Japan than the Bank of England. And I think also, just very quickly on Japan, it's interesting that the yen has been quite resilient considering a 50 basis point cut from the Fed. That interest rate differential was quite important for the yen and the carry trade and market stability, as we saw in August. So in a very different environment today than we were in August. But in terms of the UK, I think historically I've always felt that the UK has been much more domestic focused. And yes, the global picture does influence it. And I think the global factors now would really be, for any country, would be, what's happening with US growth? What does that mean for domestic trade? And what does the future tariff outlook, et cetera, what does that mean for domestic trade? Those will be the questions. But again, it's very domestic focused. But again, I think Bank of England much more independent from the Fed decision. Bank of Japan, I think a lot will hinge on the outlook from here in terms of that rate differential.
I guess another way to ask this, Sri, is does the U.S. have the unique privilege of the dual mandate because of its being the reserve currency to the world?
I think that there is some advantage there, definitely. And I think, this is obviously built into the framework, regardless of the reserve currency position as well. I think what we're seeing is that ability to not necessarily call outright victory on inflation, but I think in a lot of countries, inflation is definitely on the correct trend. So for the case of the US, you can shift that focus more towards what's happening in growth. And as we heard earlier from earlier analysts, the growth outlook in the US wasn't particularly bad. Data releases recently have actually been quite surprising on the upside, and really it's that focus on resilience of the labour market and some of the volatility in payrolls recently and that downward revision from the BLS. All of these things are just providing some cause for concern. The fact that SARM rule has breached the recession trigger level, all of these are quite concerning for the markets. And so we saw that 50-50 pricing up until yesterday. It was, there was a lot priced in for a 50 basis point cut. today. So it's really, I think the backdrop was quite prime for the Fed to go 50 front load and just get ahead of the situation. Any accusations of them being behind the curve are probably ruled out by now. And I think if they just go on that 25 basis point pace for the next 2 meetings, and even if they then shift to every other meeting for next year, it's still on track for providing that buffer for the economy and for the labor market. So there, I think, they've probably made a good decision in going for 50, given what was priced in and some of the narrative in the market.
Surprised economists yesterday, did not surprise economists this morning. Sri Kochagoverdan of Aberdeen. Sri, thank you. The Bank of England leaving rates unchanged. Cable, 133, the pound stronger against the dollar, levels we haven't seen since spring of 2022. I'm pleased that Sri brought up the Federal Reserve and the commentary around growth, because we talked about this yesterday in the programme. If you missed it, in the news conference, Chairman Powell, I would say almost sounded really, really confident, almost buoyant, jubilant about what was happening in the US economy. It was kind of bizarre. At the same time, you're cutting interest rates by 50 basis points. Labour market conditions are pretty close to maximum employment. Retail sales, GDP show the economy growing at a solid pace. We're not seeing rising layoffs or hearing it from companies. He didn't want to say it, but it certainly felt like mission accomplished.
He's recalibrating, John. This is a recalibration.
Thanks, I missed that.
It's going to be a recalibration going forward. This is a sign of their commitment to make sure they do not get behind the curve. This doesn't guarantee the pace going forward will be 50 basis points, but it does guarantee their commitment to avoiding something that looks like a hard landing, rhymes with a hard landing, sounds like a hard landing, anything even close to it. It's not mission accomplished, but it's,
It was a decent piece of acting, would you say? To sound like confident as you present this 50 basis point cut.
Yeah, well, basically that was his job. He is a lawyer, and he did the job.
Any more? No? Done? Equities right now on the S&P up by 1.6% on the S&P 500. Job done for now. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. In its monthly report, the Bundesbank said Germany's economy may already be in a recession. After a surprise contraction last quarter, the central bank said GDP could stagnate or decline slightly in the third quarter. In other bad news for the region, EV sales figures for August came in showing a 69% plunge in Germany last month. Boeing is requiring some workers to take unpaid leave to preserve cash. The plane maker is digging in for contentious contract talks with its largest union. U.S. workers will see 1 week of unpaid leave per month as the strike continues. The company's initial offer of a 25% pay increase over 4 years was resoundingly defeated by workers who are seeking higher raises and their pensions reinstated. Oprah Winfrey is joining Kamala Harris on the campaign trail. Oprah will join the vice president in a live stream town hall in the Detroit metro area today. Roughly 400 Harris supporters are expected to attend the 2-hour live event, with thousands more expected to watch on social media. Michigan is one of the 3 critical blue wall states critical to Harris's victory. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, tax cuts for everyone.
Trump's like, the old Oprah joke, right? You get a car, you get a car, you get a tax cut, you get a tax cut. Harris is less so. I mean, it's a meaningful difference.
Did he get that from you?
I think so. It's the Oprah Winfrey election.
There we go.
Everyone gets a cut.
Trademark.
You've got to cite things.
Registered.
Adam should know better. He's an academic.
Terry Haynes cited me.
That's conversation just around the corner. From New York, this is Bloomberg.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The rally resumes, up by 1.6% on the S&P 500, higher on the S&P, on the Nasdaq, on the Russell. In the bond market, muted price action once again. Bit of a disconnect there. The 10-year 371.13. Under surveillance this morning, tax cuts for everyone.
Trump's like, you know, the old Oprah joke, right? You get a car, you get a car, you get a tax cut, you get a tax cut. Harris is less so. I mean, it's a meaningful difference. But, you know, the key question is, as Reagan said, as Biden said, is it spending to increase supply? Is it investment, or is it spending just for spending? Similarly, tax cuts. Is it tax cuts to increase investment, or is it just tax cuts?
So here's the latest. Both Donald Trump and Kamala Harris promising to cut costs for Americans as the deficit continues to soar. Plans to reduce U.S. debt have largely remained absent from the campaign trail. Henrietta Trays of Veda Partners saying the next president is guaranteed to increase the deficit. The only question is by how much and with how many votes. Henrietta joins us now for more. Henrietta, I just want to talk about numbers. You've heard the promises. What kind of numbers are we talking about now?
Well, on the Trump campaign side, they have far exceeded the scope of the extension of just the 2017 tax bill, which on its own is $4.6 trillion. Each one of the items that Trump has talked about in the last week, whether it's repealing the SALT cap or imposing no more taxes on tips, or the Social Security change and payroll tax change, you're now up to at least $8.5–9 trillion and rising. So this is sort of the latest area where the former president has abandoned or changed Republican orthodoxy along the lines of, moving from free trade to tariff strategy. Now it's, a lot of tax cuts, absolutely no fiscal discipline.
Henrietta, we asked this question a lot to Trump surrogates. How are they going to pay for the smorgasbord of tax cuts? They all just say tariffs, but no one has been able to give us real granular details on how actually those tariffs would pay for all these cuts.
Right, because they wouldn't, for a couple of different reasons. And I don't mean to be harsh here, but that's just the reality, both procedurally and functionally. The SALT cap is the #1 revenue raiser in the 2017 bill, and that's what Trump gave away earlier this week before his rally in Nassau yesterday. That's a $1.2 trillion revenue raiser over 10 years to cap SALT at 10K, and that was the principal driver in imposing some sort of fiscal sanity on the rest of the tax cuts being extended on the individual side. On the tariff side, the problem is that that's going to be an executive action. So even if it does start generating, revenue, if Customs and Border Patrol is collecting revenue at the border, which then ultimately is passed on to consumers, which is what tariffs are, the problem is that in the tax bill that Congress writes, at no point will they be voting on these tariffs. So when JCT goes to score the tax bill that they're writing, it will not include a line item that says, oh, and by the way, we're offsetting the cost of these expenditures with tariffs. So I think both procedurally and functionally, it's a real problem to say the tariffs are going to pay for this bill.
Let's talk about Kamala Harris as well. I sort of disagree with Adam Posen there that she's also not throwing out tax cuts. She took the tax on tips from Donald Trump. She's also talking about subsidy of $25,000 if you're buying a new home. Also talking about a lot of spending, although they do have some revenue increases. How do you score that camp?
Yeah, it's exactly the same. The main restriction on Kamala Harris is going to come from the United States Senate. So there we have 90% odds the Senate is going to go red, which will be a bipartisan sort of leash on any of the Harris campaign strategies. So what that actually does is diminish the revenue that she can bring in while also limiting the amount of revenue that she can send out. So the child tax credit, for example, that $5,000 level, that's extremely expensive, $1.2 trillion on its own. but the corporate tax rate would go up to, in theory, maybe 23, 24, 25%. But the Republican Senate, that's really hard to pull off. Effectively, what you're talking about under a Biden administration, a Harris administration with Republicans in the Senate is very likely to be a repeat of 2010, when we just kick out an extension of everything that's currently on the books and have a broader conversation about fiscal sanity in the 2 years between 2026 and 2028 when that bill would expire. So another Simpson-Bowles commission, something along those lines.
I'm glad you brought the child tax credit, because we heard that from J.D. Vance as well. He wants to expand this. Kaylee Lyons brought up a good point the other day, this Venn diagram, and how in the middle there's a ton of cuts or expansion of programs that both campaigns want. Do you think, even if there's gridlock in Washington, given the fact that they're both campaigning on a number of these things, some of them can actually get over the finish line?
Yeah, and I think there's a growing possibility that next year, even if Trump is elected, Republicans might prefer to seek Democratic support for a tax bill than go alone via reconciliation. I'm still sussing this out with staff, but the deal is the Republican majority would be so small in the Senate and also the House. And think about the conflicts we've already brought up. $1 trillion for the child tax credit, no longer having a $1.2 trillion revenue raiser for the SALT cap, and all these other tax expenditure promises. The Republican appetite for a one-time hit in deficit hikes is $2.5 trillion. $8 trillion is obviously a lot more than two. So where are you going to find the revenue to offset the rest of these costs? You can either make the bill really short and have the tax cuts that last for 3, 4, 5 years, which is a gimmick that I think the bond markets would react to this time. That's what I'm hearing on the road this week. Or alternatively, you get 60 votes, you pull in 9, 10 Democrats to support your bill, and you no longer have that optics problem. So this is going to be a legislative strategy question.
So given the legislative strategy question, I know your base case is the Senate flips to red. What about the House and the White House? What's base case ahead of November?
The reality is 37% of Americans can name their congressman. So my expectation is that the House goes the direction of the White House. If Harris wins, I expect it to be a blue House. If Trump wins, I expect it to be a Republican House. There are a lot of at-risk districts in non-swing states, however, that could make Democrats' prospects under Trump just a little bit larger than what they had been in the last couple months. And this is what Kamala Harris's $380 million fundraising juggernaut has created. Effectively, she has the ability to go into all these districts in Iowa and Michigan and elsewhere around the country and really put hold the Republicans' feet to the fire and make them campaign and spend money in those districts.
Appreciate the numbers behind some of the promises. These numbers are big. Henrietta Trace there of Veda Partners, appreciate it. These numbers are big too from Axios this morning. Let me share some of this with you. The Harris-Walz ticket is on pace to do fewer interviews and press conferences than any major party's presidential pairing in modern US history. It's worth pointing out some of the why, just a small piece of the why. Harris has been a candidate for 59 days and Walz for 44 days because President Biden dropped out. So let's go with that time period, and that's what Axios has done. Listen to this. During those 59 days, Republicans Donald Trump and J.D. Vance have participated in more than 70 interviews and press conferences with TV and print reporters. Harris and Walz have taken part in 7. Vance alone has participated in more than 7 times more interviews and press conferences than Harris and Walz combined during that period.
Absolutely. You see J.D. Vance on the Sunday shows almost every other week, and they're out there doing interviews, not just these set pieces, which clearly the Democrats prefer. They want to put Kamala Harris at a rally or Tim Walz, but not across from journalists and not alone.
Doesn't feel like this is going to change anytime soon, does it?
No.
This is the strategy.
Yeah.
Up next on this program, Gargi Chowdhury of BlackRock saying it's time to get out of cash. We'll talk about where. Up next.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Financial markets can make a fool out of even the most smartest people on the planet. You look at the close yesterday, snapped a 7-day winning streak on the S&P, start writing things like hawkish 50, hawkish 50, hawkish 50. You wake up this morning, we're up 3% on small caps. On the S&P 500, up by 1.6%. On the NASDAQ 100, up by 2 full percentage points. The rally resumes.
Hawkish is a relative term. Hawkish compared to what? They still cut by 50 basis points, and that's essentially what markets are taking their signal from. We aren't seeing the same kind of commensurate move in bond markets, and I know you're going to get to that, but there is this feeling that this is a central bank committed to upholding risk assets. And I mean, you could argue this, but no one's talking about financial conditions. Peter Bukvar actually just noting that. Financial conditions have actually only eased overnight at a time where they already are quite easy.
I'm pleased you brought up the bond market, so let's turn the page and get to that story. Switch up the board and turn to bonds. Really muted price action there, even as equities continue to rip. We're down 2 basis points on a 2-year, 359. This came from Capital Economics. Is the easing cycle already priced in? Markets barely reacted to the Fed's 50 basis point rate cut on balance, and our base case is that further cuts won't move the needle too much either. That's on the bond market. That's what we're seeing right now.
Maybe that's the Olympic dive, the entrance into the water. Afterwards, you just see like a little bubble. That's maybe what this is
like
that there's a lot of noise. Yeah. She's amazing. Just incredible.
It's ridiculous.
So that's maybe what the Fed just executed with the 50 basis point cut.
Yeah,
well, I think that it sort of has us designated on certain algorithms. I don't know if that's
just
my guess.
feeding us people diving.
I get a lot of them, and I
really
enjoy
coverage.
them. Yeah, a lot of Olympics coverage, gymnastics, rhythmic gymnastics. Anyway, moving on. I will just say that this is sort of a question of whether they've actually telegraphed their path, and this is what the market is expecting.
So that's the bond market move. Let's turn to foreign exchange. 2 decisions today and tomorrow. Today we had the Bank of England rates unchanged. Tomorrow we get the BOJ. Cable right now is positive by 0.6%, so that's a stronger pound against the US dollar. It breached 133 just briefly, and then it's on to the Bank of Japan. At the moment, the yen's a bit weaker against the stronger dollar. Dollar yen back through 143. Will they or won't they hike interest rates in Tokyo?
And how much will that potentially send the yen significantly higher or significantly weaker? Some people argue that the stability that Peter Scheer was talking about as being notable highlights how the positioning has gotten that much more balanced. There was this really heavy short position against the yen that caused that complete unwind of the carry trade that was disruptive that some people were talking about. Now there's a pretty significant long position on the yen. Has it evened out enough that it's not really the story anymore, that we don't have to keep saying, good morning. Good morning, Tokyo. Good afternoon, Tokyo.
Good evening, Tokyo.
Good evening.
Dollar yen, 143. Maybe. You would just want to move on from the dollar yen.
No, I actually find this really interesting because I actually think that, to me, the story of this year has been the divergence between central banks that have a dual mandate and central banks that don't. And I think that that story is only going to continue to get focused because, to me, that is one of the big privileges of the Federal Reserve that we're not hearing from a lot of these other central banks.
Dollar yen, 143. Agreed. It's one to watch in the next 24 hours. Under surveillance this morning, thousands of electronic devices, including pages and walkie-talkies, exploding in Lebanon over the last 2 days. Hezbollah accusing the Israeli government of orchestrating the attacks, and I imagine the whole country on edge, trying to work out what comes next.
Well, absolutely. An Israeli defense minister saying this is a new phase in the war. Very vulnerable right now, Hezbollah. And we're waiting to see what Hassan Nasrallah, the leader of Hezbollah, comes out to say today. And it really potentially will change how they are dealing with Israel and Israel's northern border. They're so vulnerable. These obsolete gadgets, walkie-talkies, pagers. If that's where they are now, what an former Intel chief said to me this week is, this is what happens when you buy predictability in bulk. What else potentially could Israeli infiltrate when it comes to Hezbollah and their operations?
There was one article that framed this as Israel's Trojan horse, that essentially they created a shell company that they then sold these obsolete instruments into the Hezbollah operatives to create an attack. And this was in the planning for years. It just raises the question, are there other Trojan horses? What is the barrier to entry for Trojan horses akin to that from other groups as well? It raises a lot of questions for supply chains that I'm actually curious about to explore a little bit more.
And not just for them, but also for us, for the West, for the United States.
Right. Is this an Israel-specific thing, or is the barrier to entry pretty low and it's a failure of imagination for other actors? And that's something that I think a lot of companies are going to be having to think
I imagine that's already on everybody's radar in intelligence communities. You asked the right question earlier. I think you framed it perfectly. Is this an escalation that leads to escalation or an escalation that leads to de-escalation? Which one is it?
We don't know yet. We have to wait to see how Hezbollah responds. The issue Hezbollah would have right now is they're very vulnerable. What Israel was able to do is take out some leaders, individuals, operatives within the group. They all now need to recalibrate. And not only that, this absolute degradation in their trust. How do they know they can communicate with one another? So it's very tense times right now. But at the moment, when you see the United States coming out and saying we don't want a wider spread of war, this already is, as Norman Rule said, this is a warlike conflict. Whether or not it's name only, it is a warlike conflict.
I think it's difficult to disagree with that take. Let's turn to this story. Boeing furloughing tens of thousands of its salaried staff to preserve cash. As its largest union continues to strike, they will work a rolling schedule of 3 weeks on the job and 1 week without work or pay.
Man, it just gets worse and worse for Boeing, and here's the issue. How are they going to move forward at a time where they need an infusion of cash? They're having a lot of questions around their space aircraft proposal. They're dealing with an aging workforce that's disgruntled, and they have a new CEO that's walking into this mess who has to fix it. It's very difficult to see how this moves forward at a time where they have to raise money, and it's only getting more expensive to do so.
What was the number we heard earlier this week? 10 billion? Something like that. The credit rating companies hanging over them as well.
Yeah.
Not a great position.
Yeah, they're about to be potentially downgraded, and if they're downgraded to below investment grade status, you have to imagine that the borrowing costs go up that much more. If they raise money through an equity infusion, what does that do more to stocks that have already been beaten up so far this year? They're kind of in a difficult situation, to put it mildly.
It's been that way for a while. Boeing this morning at least up in a pre-market by a little more than 1%. Let's talk about the latest in Washington. The U.S. House rejecting Speaker Mike Johnson's stopgap funding bill with less than 2 weeks until the government shutdown deadline. 14 House Republicans joining a chorus of Democrats in voting against the bill.
No surprise here, really, but the question now remains in Washington, what is Speaker Johnson's plan B? Greg Valliere out with a note today saying he's going to consult with these rebellious House members, but time is running out, and that's the issue here. But the markets at the moment really aren't paying attention to this. At the end of the day, everyone thinks they're going to get through this. You know why? Because they have to go home and campaign. They have to get back in their districts.
Yeah, this isn't a great thing to campaign on, as we've seen over the last few years.
Especially because Speaker Johnson was trying to get consensus and bring the Republican Party together while sowing dissent among Democrats. This didn't do that.
Top story in the last 24 hours, this one right here. Markets digesting the Fed's 50 basis point cut. Gargi Chowdhury of BlackRock writing this. Near-term volatility aside, this will create a fabulous opportunity for investors to move out from cash and lock in yields in the belly of the curve. For equities, a brief pullback is likely, but eventually a rate-cutting cycle that ends without a recession tends to bode well for stocks. Gargi joined us for more. Gargi, good morning.
Good morning.
I imagine you've had tons of calls. I'm sitting in cash, they've cut 50, I'm worried they're going again. And again and again and again. What do I do? What do I do?
You step out of cash. I think that the signs that this Fed meeting showed us all beyond the 25-50 debate, hawkish, not hawkish, etc. Once we go past all of that, I think one thing is clear. This is a Fed that is going to, that is willing to surprise the market, that is going to do what it thinks it needs to do to make sure that the labor market and the broader economy remain strong. And they will cut 50 basis points and maybe another 50 more, or perhaps even more than that if they need to, while growth remains solid, right? While growth remains at 2%. And that is an amazing opportunity to own risk assets. So own risk assets in the fixed income markets, own fixed assets, risk assets in the equity markets, I think seasonalities can get a little bit tough, but this is a great time to step out of cash.
Let's break up the asset classes.
Yes.
We'll start with bonds, we'll move to stocks. In fixed income, when you say take risk in fixed income, in bonds, what do you mean?
So first of all, I think making sure that you're very precise about where you want to target your interest rate sensitivity or duration risk, that's really important. We've been here before and talked about owning the belly of the curve. What we've meant by that is really looking at that 3 to 7 year part of the curve, and not just owning treasuries, but owning high yield, owning securitized assets, owning income, really taking this opportunity of still locking in yields, especially when cash yields are dropping fast, and earning income in the fixed income markets. And there are products that allow you to do that in an active manner, in an indexed manner, but the time is here, the time has been here, but you're not too late.
Let's have a therapy session, because a lot of people are feeling like they missed it. And a lot of people feel like, you know, they're watching as valuations get that much more expensive in stocks, in bonds. I'm looking right now at credit spreads tightening even more on the heels of this decision. How do you convince people after so many discussions that things have gotten so frothy and so expensive that now, as things are even more expensive, it's the right time to buy?
So, okay, separating out bonds and stocks again, I think for equity markets, this is a seasonally weak period. We're going to have a couple of risk events. We're obviously going to have the election in in 6 weeks or so. But more importantly, before that, we're going to have earnings season. And I think it could maybe make sense for equities to pull back just a little bit. I don't think you're supposed to step away. I think you're supposed to add downside protection with buffered strategies. That's what we're telling investors. Or move a little bit further up in quality. We've sort of told investors to stay away from the small cap trade. Obviously, that's doing very well. It's hard for me to imagine that does well sustainably for the next 8 to 12 weeks. Having said that, in the fixed income markets, Lisa, I hear you. Yes, spreads are very, very tight. But I think what investors have gravitated towards, if we look at fixed income flows this year, it is around yields that are available. So when we compare the yields today to what we were getting 10 years ago, yes, it's come down, but it's still very positive. And I think investors do want to lock that in, especially if we slow down even slightly from here.
You talked about some risk events, including the politics, and I know Anne-Marie is going to go there a bit in a second. There is this issue that every candidate is going to promise more and more and more to increase the deficit more and more and more. Does this create something of a risk event that is longer term, particularly for the long end of the yield curve?
I think it does. You've hit the nail right on the head. I think that's why being very precise about where you want to own duration is really important. So regardless of what happens in November, regardless of who's president in January, I think one thing that we can be sure of is that deficits aren't coming down in a rapid manner. And one of the ways in which that can play out in our markets, in the bond markets, is really in the very long end of the curve. So I was saying earlier to John about, owning duration in that 3 to 7 year part of the curve. You kind of want to stay away from the very long end for now. You're not getting that additional pickup in yield. So stick in the belly of the curve and harvest some of the income that you're getting. And frankly, that's where investors are moving to as well. I mean, when I have client conversations, people want to hear about the ag, people want to hear about BINC, people want to hear about, quality equities. That's what we're telling them to do, because that's the regime for this.
Henrietta was just talking about how investors she's talking to, especially those in the fixed income space, are interested to see what happens in Washington based on the timeline. If you get some of these tax cuts 3-4 years out, or if they go for, say, 10 years.
Right.
Do you think it makes a difference?
For bond markets, and I think it all makes a difference, absolutely. I think we're in this period for the next 6 to 8 weeks where we just won't know too much. We obviously won't know the outcome. And I think markets like certainty the most. They want certainty, which is why I feel like over the next couple of weeks, I think a little bit of a pullback despite this 50 basis point cut could come. And I think that's fine. You're supposed to stay invested, protect your downside. But I think, of course, it matters. In the long term, will it matter whether we get something for 4 years or 10 years? Absolutely. I think the market can only pay attention. Rick Rita, who's, as you guys know, likes to say this, markets pay attention to one thing at a time. Right now, we're paying attention to all of the amazing opportunities that the Fed cut has brought you.
Well, I know, but next we're going to be focused on the election and this idea of fiscal sustainability. Henrietta also brought up the fact that maybe we'll see another Simpson-Bowles commission. Does the market care about that, or is that just all noise and talk?
For now, I think the market won't really focus too much on that. I think we're going to focus a little bit more on, what is the data telling us? What are some of the policies that we're going to get? What are some of the ways in which the earnings season is going to play out? I think that's going to be something that we're not talking about yet. We did see earnings okay. We didn't see, companies weren't doing as well on revenue. So I think we have to see whether companies can still find ways to cut expenses, and that's something we're going to be looking at. So for the near term, I think all of that is going to be much more important than if we get a commission, 12 weeks down or 20 weeks down the lane.
Can we say that for now, Wall Street is sick of talking of the Fed?
I think so. I think I'm really excited that we can now focus on what's really important, which is
the election.
No, actually, which is the opportunities that exist in the market for our investors to be invested and have a better financial outcome.
Gargi, thank you.
Yeah.
One of the best. Always enjoy it. Gargi Chaudhry of BlackRock. There's a line that Rick used with me a long, long time ago, and I've never forgotten it. The market, it can only focus on the shark closest to the boat. Isn't that the truth?
It was, and 25 or 50 was that shark for a long time, and people are very excited to have another shark that's maybe FedEx earnings after the bell.
No, now it's November 5th.
Yeah.
It's November 5th.
She said, no, actually it's not. So I think that, Wall Street will be very excited to turn the page on that one too.
Gargi, it's good to see you. Thank you. Yeah. Thank you as always. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. JP Morgan has put a banker in charge of junior bankers' well-being and success. That, according to reports, citing a memo from JP Morgan. It appears to be a response to renewed concerns about overworked young employees on Wall Street. JP Morgan also recently capped junior bankers' working week to 80 hours, although Bloomberg reported at the time that the limit didn't apply to those working on live deals. The International Brotherhood of Teamsters will not endorse Kamala Harris nor Donald Trump. Teamsters President Sean O'Brien saying in a statement, we sought commitments from both Trump and Harris not to interfere in critical union campaigns or core Teamsters industries, and to honor our members' right to strike, but were unable to secure those pledges. Donald Trump made a pit stop at Pub Key, a Bitcoin-themed bar in New York City last night on his way to a Long Island rally. The bar's owner said that the former president spent $998.70 on a few dozen burgers for supporters. He paid for the food with Bitcoin. In July, Trump gave a keynote speech at a crypto conference, promising to appoint a crypto-friendly regulators and create a national strategic stockpile of Bitcoin if he returns to the White House. That's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Check out the price action. Stocks higher by 1.7% on the S&P 500. The small caps absolutely ripping this morning. On the Russell this morning, up by close to 3 full percentage points. We'll catch up with Mike McKee in just a moment.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
given how muted the price action was yesterday in response to the 50 basis point rate cut of the Fed and the news conference as well. It's a surprise to see this rally this morning on the Russell. The small caps up by 2.9%. On the S&P, we're up by 1.6. On the Nasdaq, we're up by 2 full percentage points. In the bond market, yields look like this on a 2-year, 10-year, and 30-year. The 2-year at the moment down 4 basis points at 357.30. The 10-year just about unchanged at 370.56. There is a bit of stability in the bond market, at least. That's not surprising, given what we heard and all the commentary around the Fed yesterday. What's surprising is to see that rip in the equity market through this morning so far.
Priced into the bond market, but maybe not priced into the stock market in terms of a Fed that is willing to cut rates aggressively, even at a time where they reconfirm basically their belief and their commitment to achieving a soft landing.
Let's pick out a single name. Shares of Alaska Airlines gaining in the pre-market this morning. The Department of Transportation giving the airline its blessing to close a $1.9 billion merger with Hawaiian Airlines. Under the terms of the deal, Alaska and Hawaiian must protect the value of loyalty programs and maintain key routes as well. This is the first time the DOT has required airlines to agree to binding enforceable protections before approving a merger. To discuss, I'm really pleased to say that giving us some of his time this morning is the Transportation Secretary, Pete Buttigieg. Secretary Buttigieg, welcome to the program, sir. I want to start with this deal and talk about some of the work you've been doing on it and whether you think this could serve as a model, an example for future integration in the industry.
Well, thank you. Yeah, we believe it really does represent a new chapter in the way the DOT approaches both consumer protection and competition. Our department has a lot of authorities, and in my view, that means a lot of responsibility when it comes to competition. I think the Department of Justice's role is well known and well understood. The Department of Transportation's role less so, partly because the department has not been very proactive over the last 30 years or so as these airline mergers have come along. But we are concerned with competition, and we are also concerned with consumer protection. And so when this deal came before us, we saw that the Department of Justice did not intervene. We still wanted to make sure that there were protections in place, which really come into two categories. One of them has to do with service itself, making sure that in places like inter-island service in Hawaii, that nobody is made worse off because of this deal. But secondly, consumer protections that are in line with what we're trying to do more broadly for airline passengers. Things like making sure that there's family seating available. Alaska does that. Hawaiian had not. We want to make sure it's the better and not the worse of those two, and so they've committed to that. And then probably the most new, and I think one of the most important things that we're doing, the rewards program, and making sure there are provisions related to that points and miles system too. That really is breaking new ground for us as a department, but it's increasingly a very, very important part of the customer experience, and it's looming larger and larger financially too. So we wanted to make sure it was contemplated in this agreement before we approved of the merger.
Secretary Buttigieg, could the DOT have done anything different when it came then to JetBlue and Spirit, given you're now likely going to be using this blueprint?
Well, of course, every proposed merger is different. The DOJ took action based on a real concern about what would happen on many routes, and our department took the step, again, something that our department hadn't really typically done in the past, of aligning ourselves with that and supporting that action. But yeah, I do think there are cases where if it's not something that just outright must be prevented by the analysis of competition law, still is something that you need to make sure it goes forward on terms that are consistent with our responsibility to support the public interest. And those public interest determinations, a lot goes into that, a lot of market analysis, a lot of legal analysis. But the sum total of it for passengers should be a better passenger experience and some assurances that this will mean a level up to the best rather than a level down to the worst of two worlds when you have multiple airlines coming together.
Well, I guess I'm asking because Hawaiian Air really needed this cash infusion, the same way Spirit Air desperately needs a cash infusion. So why is the administration willing to let one country get the boost one airline get the boost they need and not the other?
Well, again, there's a lot that goes into the competition analysis. A lot of it has to do with the loss of competition on key routes, evidence informing DOJ and us in a separate but somewhat overlapping scope of analysis. What happens to prices that consumers face? And look, part of why this is a concern is because of what's happened over the years. You know, during the period when America went through the debate over deregulation, which led to our modern airline system, a lot of the people involved in that policy were confidently predicting that in the future there would be about 100 airlines in the United States. Instead, we've seen merger after merger, lots of consolidation, and so it's very important to take a very hard look anytime there's a proposal to go from more airlines to fewer airlines in a country that already has so few.
Secretary, we're talking about fewer airlines, et cetera. We're having a question about whether we're going to have fewer planes. What's the threshold for the United States government to subsidize Boeing at a time where there are real questions about its ability to continue to invest and its workers are striking?
Well, Boeing has historically been an aerospace leader, right now encountering a number of issues related to quality and safety that the FAA has required them to demonstrate how they're going to address, and, as you mentioned, labor issues as well. If you look at how Boeing competed so well in the past, it had to do with a focus on quality and on safety. And I believe that's absolutely compatible with doing right by workers and with Boeing's place in America's economy. But again, the most important thing, certainly from a Department of Transportation perspective, is that the safety and the quality are there, because everything else sort of gets multiplied by zero if you have those kinds of problems that can, you know, sure, they can shake the market, but the most important thing is the safety of the traveling public.
Mr. Secretary, appreciate your time this morning. Hopefully we can have a longer conversation next time on some big issues. Thank you, sir. Secretary Pete Buttigieg on the latest in the airline industry, and just a little bit at the end there, Lisa, on Boeing.
Yeah, at a time where they see that there are problems, it is important for it to be an industrial leader. At the same time, very unclear exactly what the threshold would be for them to truly step in and help out.
And how important Boeing is to the industrial base. So at some point, would the U.S. have to step in? You know, I'm curious, Biden loves to tout the fact that he is the most pro-labor union president. Will he go potentially to the Boeing factory floor?
It's a good question. Up next, the third hour of Bloomberg Surveillance, Phil Camporelli of JP Morgan, John Lovello of UBS on the housing market. Looking forward to that. We'll catch up with Mark Zandi of Moody's Analytics, and we'll speak to Subhadra Rajappa of SocGen on this bond market following a 50 basis point interest rate cut from the Federal Reserve.
But at least there's a theory of change.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
So we know that it is time to recalibrate our policy to something that is more appropriate. This is the beginning of that process.
The press conference challenge was give 50 without spooking the market. I think they navigated that pretty well.
I don't think it is as clear-cut as the market will make it seem.
They're starting to get towards neutral. All is well.
It's a soft landing kind of story, and I hope they can pull it off.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
All is well. It's a soft landing kind of story, and that's what it looks like in this equity market this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now. This stock market is ripping. Check out a Russell on the small caps, up by almost 3% on a session. We're up by 2.7. On the Nasdaq, up by 2 percentage points. On the S&P 500, up by 1.65. All is well. It's a soft landing.
And back up the truck, because let's go. And that's basically what we're hearing from pretty much every investor as they come on and they say, buy risk, because this is a central bank committed to supporting the soft landing. I keep going back to it. Blake Gwynn over at RBC, you did a great job here talking about never has so much been made about so little, saying this was one of the most debated and discussed Fed meetings in recent memory. We're all very happy we're past that. But the Fed's eventual decision to cut 50 basis points landed in markets with about the same splash as an Olympic diver.
Yesterday, after Jay Powell spoke, you guys had Mohamed El-Erian on, and he wouldn't go as far as saying, basically declaring victory, but he said, Jason Furman put it well, this is about the closest thing you can do to say, mission accomplished.
Mission accomplished. Didn't want to say it, but basically it sounded like it, didn't it? When you start to go through his analysis of where the economy was at, decent place, growth is solid, no firing, lots of hiring, less hiring than before, but still pretty decent. Things are okay, and we're cutting interest rates. What isn't there to like?
Everything is golden. And basically, there was a tacit concession here that they missed the boat in July. He said, quote, if we had gotten the July jobs report before the meeting, jobs inserted, would we have cut? We might well have. In other words, we're behind the curve. We realized it, so we caught up. Here we are. Let's go.
This is what we heard from UBS earlier this morning, that maybe that 50 should be seen as a catch-up, 25 altogether, and maybe not something that sets the tone for the rest of the rate-cutting cycle for this Federal Reserve. That's going to be dictated by the incoming information, but I think he went out of his way in the news conference yesterday to say this is a recalibration on repeat about 10 times. We'll take it meeting by meeting, and this doesn't set the pace for the rate cuts still to come.
They're recalibrating policy, and the market is done recalibrating because they basically have already moved ahead of the Federal Reserve. And that's why what you've really rightly pointed out is the market move to note, which is bond markets stagnant. They basically price this in. stock market's understanding this doesn't come with any weakness because he correctly or successfully delivered the message that they're not seeing anything that we're not seeing. Now they're focused on the revisions in the beige book.
Check out the price action. I don't know if they are focused on the beige book so much. Maybe you will be.
He said that.
The revisions, yes.
He said revisions, but he also mentioned the beige book. He talked about it. We're going to be looking at the beige book. The Philly Fed talked about there are more layoffs. We're going to cut rates by another 75.
We all need some sleep, don't we? In the bond market, yields are higher by almost a basis point, 371 on a 10-year. In the equity market, there's your move, up by 1.6% on the S&P 500. Joining us this hour, Phil Camporelli of JP Morgan, as markets digest the Fed's 50 basis point rate cut. John Navarro of UBS previewing Lennar earnings, and Subhadra Rajappa of SocGen on why it's harder to argue for lower yields from here. Look out for that a little bit later. We begin with our top story, a muted bond market response to a 50 basis point rate cut, as Fed Chair Jay Powell says this should not be seen as the new pace. Phil Camporelli of JP Morgan saying these are calibration cuts for an economy that does not need as restrictive of a policy rate. We are only assigning a 20% chance of recession in the next 12 months and believe growth will normalize with inflation around 2.5% by year end. In other words, that is a soft landing. Phil joined us for more. Phil, good morning to you.
Good morning.
Last time we spoke, you were happy, confident, you were long bonds, you were long equities. Are you long more on one than the other this morning?
Yeah, so I would say our bigger risk in the portfolio right now still remains equities. And yesterday's meeting was a throwback. I mean, we're talking about like Greenspan days, where you check out the size of his briefcase to see how much they're moving, right? I mean, that was the first meeting, in our opinion, since 2007 that there was that much uncertainty about which way they were going. So I was like, this is great, because in January of 2012, they came out with their forward guidance, and these Fed meetings have been snoozers, with exception to inter-meeting moves or dot plots. Yeah, or dot plots. But yesterday was a throwback, and we loved it. And when I was on your program, as you said, a couple of weeks ago, my big takeaway from Jackson Hole was the time has come for policy to adjust. That made all the headlines, but the real headline that gave the 50 basis points away was we have no tolerance for further cooling in the labor market. And it's a tale of two 4.4s now. It's the 4.4% unemployment rate at the end of this year. That got them to move 50 yesterday. And then the 4.4% that they think they're going to have the federal funds rate at the end of this year, which is two more additional 25 basis point cuts. And we've heard, I've been telling this story since money market fund assets were $5 trillion. They're 6.3 to get out of cash. But now the real story that we're telling folks is, the balanced portfolio looks great. Lisa, you've talked in the prior session about all-time highs and stuff like that, and where stocks have gotten to. It's the 493 that we're really focused on right now. So outside of the big mega cap, it's the 493, and those valuations are two handles on PE below where the mega cap are. So there's still room there, and there's still room in some part of the pool, right? The shallow end of the pool is equal weighted S&P. The middle of the pool is mid cap, and the deep end of the pool is small cap. So there is room still left in that. If we're getting this new signal that we're going to have the federal funds rate most likely 100 basis points lower than where we were before 2 o'clock yesterday at the end of this year. They're going to continue to move into next year. The unemployment rate next year is going to be at 4.4. I mean, let's go. Let's sign up for it.
I'm not sure what's in the water at JP Morgan, but the last 24 hours, basically everyone from JP Morgan stared down the camera and said, we told you so. We told you so. We saw it from Bob Michael yesterday as well. Yeah. I imagine Mike Ferroli over in the investment bank was thinking the same thing, was looking for 50. He got 50.
You get this sense under the hood. There is this frustration with the amount of cash that has not left those money market funds.
Yes, no matter how long.
There's some funds to sell, Bramo. There's some funds to sell.
Well, the opportunity cost in cash hurt you in the past 2 years.
You tell them.
Now it's reinvestment risk, John. It's all.
Can I ask you this important question? Please. Is there such thing as too much of a good thing?
Yeah, I guess the most bearish thing you could say is that everybody's bullish right now. So I think there is kind of too much of a good thing. And, in our opinion, the one thing that we're looking at comes out in 23 minutes, which is initial jobless claims. I think those are probably the biggest things that we're going to be looking at as a clue of whether we're wrong on the soft landing. Right now, we don't see any reason to believe that business caution is going to lead to layoffs. labor demand side of the way the unemployment rate can go up rather than labor supply, which you guys have talked a lot about. But that would be the biggest risk to us, would be the labor market. And inflation, the nails in the coffin, you said mission accomplished. The nails in the coffin on transitory.
I'm just saying that he was basically saying, I just want to be super clear.
Come on.
No one on this program is saying mission accomplished.
The Arthur Burns moment that I think that a lot of folks were worried about, the nails in the coffin on that. Yesterday's meeting was inflation is transitory.
Fabulous 493, terrific 2,000, boring bonds, and potentially, I don't know, not necessarily great bonds. How much is the risk now in the bond market that you can't potentially get a further rally in treasuries at a time where we've priced in a lot of cuts and potentially are looking at inflation that's going to be stickier on the heels of some of the strength we're seeing in risk?
Yeah, good question. You brought that up yesterday when it came out as well. I think that's a good point, that there still remains two-way risk on inflation. But I'm a multi-asset investor. So for me, I can say, okay, I think we're going to have a soft landing, and I want to be overweight equity. We have about a 6% overweight equity in a 60-40 portfolio.